If you look at what's driving the market, and is it a very small group of companies? Absolutely. That's very concerning.
What we're seeing in the large cap space is, at least on a short-term basis, a lot of good news is priced in.
Everybody at this point is functioning under the fog of uncertainty.
Markets tend to dislike uncertainty in any form.
There is a sneaky Uber bull case out there lurking.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning from New York City. For our audience worldwide, this is Bloomberg Surveillance. This morning, alongside Matt Miller, I'm Annmarie Hordern. Coming into Friday with stocks closing at all-time highs, Fed Governor Chris Waller once again calls for the Fed to lower interest rates in September and look through tariff impacts on inflation.
Prices will go up and it'll be more expensive. What is it special about tariffs? So that's kind of where I'm at. I'm back on team transitory.
We'll get a fresh read on prices with the Fed's preferred inflation gauge out at 8:30 Eastern. Then at 10 a.m. in Washington, D.C., a hearing is set as Governor Lisa Cook requests a restraining order to stay, Matt, at the central bank.
Yeah, this Cook story is just getting out of control in a way that, you would expect to move markets. And yet we're seeing the 10-year hover at 420. It's just shocking to me that the bond markets don't care at all. I mean, there must just be so much liquidity that it doesn't make a difference.
Well, I think right now the market is just basically thinking this has to play out in the courts before they actually start considering if this really is the president impeding on Federal Reserve independence. And that's why everyone's going to be focused on the data. But when it comes to the data...
Did you say if this is the president impeding on Federal Reserve independence? As if there's a question?
Well, there is a question amongst a number of people on what for cause actually means. And at the end of the day, that'll be up for the Supreme Court to decide. But that is why the market is focused on data. But do you have to even worry about the inflation data today when you just heard Fed Governor Chris Waller double down saying we need a September rate cut, even opening up if the data is very weak to potentially a jumbo rate cut, and saying the tariff impact, look through it for now.
Yeah, he also said that inflation is hovering around the 2% target rate when it's well over 50% above that. Like, if you owed me $100 and then I demanded $150, that would be unfair, right? I can't believe that no one cares about inflation above 3% and going the wrong way.
That's right. They are pretty much ignoring inflation because they're concerned about the labor market. The labor market report next week will be the most important data point, I think, for this upcoming month of September.
Right, but we're at 4.2% unemployment. I'm 51 years old. I've never seen unemployment this low, right? It's the lowest it's been since the 60s. So the labor market would have to get a lot worse before we move out of full employment.
Sounds like you are not in favor of a rate cut. You would not be under the president's list for potentially becoming the Federal Reserve chair. Coming up in the program, Matt is joining me this morning. You could tell it's a Friday in the summer when John and Lisa are off and they let Annmarie and Matt do the show together. Brian Nick of NewEdge Wealth with stocks pulling back after hitting all-time highs. Ed Mills of Raymond James as Fed Governor Lisa Cook's lawsuit heads to the courts. And former NEC Deputy Director Everett Eissenstat as the U.S. closes a trade loophole. We begin this hour with futures softer as investors await the latest read on inflation. Brian Nick of NewEdge Wealth writes something big and something negative would have to come along to knock stocks down in a significant way. And our imagination is running low on what that might look like. Brian joins us now. Your imagination is running low. Why? Because nothing so far we've seen out of Washington has pushed this market to recalibrate. Is that accurate?
Just the tariffs in April, which were quickly rolled back, and then have kind of been rolled forward again, but more in a kind of a slow way that markets have more time to digest. But you're absolutely right. The Fed independence issues do not seem to be affecting markets. I think the one area where we are seeing it show up is the steepness of the yield curve. If you look at the TIPS curve, short data TIPS yields are moving down because inflation expectations are getting higher and expectations for rate cuts are getting priced in. That's pretty unusual to see those two things happening at the same time. Meanwhile, the longer end, we've seen rates climb higher and higher and higher because there is this sense that whatever dovishness the Fed is going to undertake now, whether it's just the people on the FOMC becoming more concerned about the labor market or because the Fed is losing independence and is going to become more dovish, that we're going to have to pay for that sometime in the future with higher interest rates down the road. So that is where that we call it zoo steepening because it's a bull market at the front and a bear market at the back. Lots of animals involved. And that's one of the things you typically see in countries where there's a concern about a loss of central bank independence.
You also say your clients seem to be at least tactically accepting this stagflationary light environment. So what do you do in that type of environment?
Stagflationary light just means that we're not seeing a recession, but we're seeing growth fall from at trend to below trend, and we're seeing inflation rise from too high to much too high. And in that trend, I think people remember 2022. They're traumatized by the dual losses in stocks and bonds, and especially risk-adjusted bonds did much worse that year. So people are avoiding duration. They're asking us questions, why would I want to get into the equity market at all-time highs, very high valuations? And we're seeing more conversations just about how to manage cash. How can you get some yield at the front end? And the good news is, unlike the 2010s, where you were basically accepting zero, you can at least get 3, 3.5, sometimes 4 and above, depending on how much credit risk you're willing to take. And people will seem to be okay with that because the outlook for the equity market from here, for a lot of our clients, is not really that robust.
So are a lot of people actually hanging out still in cash? I mean, when I talk to asset managers on my program, Bloomberg Open Interest, every day from 9 a.m. to 11 a.m.
Oh, please.
Asset managers, wealth managers are saying they do have trouble pulling people out of cash still, even, I guess, because of the fact that we're at all-time highs.
I would say that most of the cash we're seeing in client accounts right now is actually coming out of fixed income. Their fixed income allocations are not as robust. It's been a tough year for municipal markets. So if you're a high net worth investor, you have tax sensitivity. Munis have had a tough year because there's been so much issuance. So they're saying, well, instead of taking that risk, why don't I just hold that part in cash? I can deploy it later. We are seeing a willingness to take on equity risk both in the public and private markets. I don't think there's a loss of appetite there yet, but it's the incremental dollars that are not maybe going into that kind of that fully invested portfolio because we have seen everything have such a good run this year.
By the way, how much room do we really have to run higher on equities? I mean, valuations are historically at a fairly high level, right? 6,500 on the S&P 500 is an all-time high, even when NVIDIA's forecast or outlook, in a sense, was tepid, disappointed many. It doesn't look like they're going to sell a ton into China, at least if the Communist Party has anything to say about it, right? And CapEx is, maybe priced too high for the actual return that you're going to get on the AI investment.
Yeah, so the S&P 500 is usually close to all-time highs. About 50% of the time we're at all-time highs or within 5% of it. So it's a normal kind of state of being for the market.
It just goes up and to the right.
It tends to go up and to the right, and even when it's coming down quickly, the recoveries in the last couple of years especially have been very robust. That said, our long-term outlook for the equity market is that the returns are going to be lower than they have been over the prior 5 or 10 years. So investors who are used to 12 or 15% returns on the S&P 500, fueled by things like the secular AI story, we're looking at more like 6 to 8% as a realistic target. That's really where the valuation comes in. It's not going to tell you over the balance of the year, are we going to get a correction? It's going to tell you over the next 5, 7, 10 years, what kind of returns can you expect? And that's where we're getting cautious and where we think there's other places in the portfolio where people should be adding money.
Where else?
International is always a very tough conversation. We've had a better year this year. I think there's going to be more investors who are receptive to it after the year we've had.
Why is it so hard? Just because we're American?
Well, because of the underperformance. Why, put me in
historic
something
underperformance.
Historic underperformance. Yeah. So you're telling me to put some money in something that's underperformed almost every year. You have to go back to 2017 before this year, where you had a year where it outperformed. But I think we're also talking about alternatives. There's other ways. Private infrastructure, private equity. Private credit still looks like it has some room to run, and people who value income are going to get more bang for their buck in that kind of environment. But the large cap U.S. market itself has been the place to be, and that's very hard to kind of get people to pull money out of that and to diversify.
When you say international, do you mean Europe or Asia or just all of it?
So this year, China's been a huge part of the story, especially more recently in the summer. Earlier in the year, it was Europe and European banks, which is not a place that was a very popular investment destination. So we're diversified. We kind of look at it all as kind of one big pot, but it is an area where instead of looking just at the indexes, there are areas where people can outperform by, say, tactical asset allocation, country allocation. So there's more room for active management, we think, in international than there is in S&P 500.
Europe's already run pretty fast. I mean, the DAX up 20% year to date. The IBEX 35 up 28%.
And with the dollar, it's up even more.
Exactly. So, and that's my question. Does the dollar continue to come down? Because so much has been made about this 10% drop from the highs. But if you look at it historically, it is still incredibly strong.
It is still incredibly strong. To get incremental weakness in the dollar from here, I think you need to see more interest rate cuts from the Fed than what's priced in, and probably better economic performance and fewer rate cuts than what's priced in the UK, Europe, and some of the other central banks that have been cutting. That could mean that the dollar, in an environment where the U.S. macro picture is weakening, also gets weaker, which is not typical. Usually when growth is weaker, the dollar tends to be the sort of safe haven and we get a little bit of an increase. That could be one of the sort of special privilege aspects, the fact that the dollar tends to be negatively correlated to interest rates in the economy. That is one of the things that we could be seeing get lost.
Well, what if President Trump really is threatening Fed independence, which I doubt anyone, disagrees with. What if he starts to fire statisticians because he doesn't like the numbers, What if we start to run up massive deficits, like 6-7%, and then have debt climb $3, $4, $5 trillion over the next 10 years? Does that weaken the dollar?
It has weakened the dollar. So that's certainly one of the reasons you saw the dollar in the first part of the year. The U.S. sort of became this loss of a safe haven, less of an attractive investment destination, and so people are pulling their money out. I think you're making the point that all these things have happened and the dollar is still quite strong. I'd say that the incremental news for the Fed, whether Lisa Cook retains her spot in the FOMC or not, is that there's going to be a rate cut in September. Even the Fed leadership that's been sort of in opposition to Trump, or at least Trump's been in opposition to the Fed leadership, has kind of acquiesced to that. So in the near term, it doesn't change the path of monetary policy. There is this tail risk now, though, that we get a lot more rate cuts next year if you start to see that independence eroded, and other central banks that have lost that independence.
By the way, rate cuts and still a rising long end, right? So like we saw in 2024, the Fed funds rate goes down and the long end yield continues to rise.
So I'd say where we're definitely seeing this is the long end is higher than it would be without all of these other risks, right? If you took away tariffs, you took away concerns about Fed independence, BLS independence, I think you would see, and you've seen it, the term premium has been rising, the 10-year would be closer to like 3.5%. Wouldn't be that low like it was in 2021, but we were probably paying 75 to 100 basis points right now for general risk around the long-term fiscal monetary outlook in the United States.
And what is so ironic is actually that's where the Treasury Secretary and the President want to see. They would love to see a 10-year under 4%.
And the concern is that loss of Fed independence doesn't just mean you're cutting rates at the short end. It means you could be monetizing the debt. Other central banks that have done this, the central bank has gone out and actively bought. And the U.S. did this during World War II. We were buying all of the Treasury issuance during this period where we had a huge expansion in debt. And that kept the 10-year Treasury at 2.5% throughout that entire period. And only as the Fed kind of pulled back from that practice did you see your interest rates rise in the 50s and 60s.
Really smart. Thank you so much, Brian, for joining us this morning. Brian Nick of NewEdge Wealth. We thank him. Let's get you an update on stories elsewhere we're watching. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, Annmarie. I'll pick up where you left off with Brian there. Fed Governor Lisa Cook heading to court this morning to try and keep her job. Cook says that President Trump's using a phony pretext that doesn't amount to sufficient cause to fire her. Cook's lawyers suggested an unintentional clerical error may have been behind the mortgage dispute at the center of the clash between her and the president. Elsewhere, Russian President Vladimir Putin and Indian Prime Minister Narendra Modi are set to meet in China with President Xi Jinping on Sunday. The two-day summit will focus on the ongoing wars in Gaza and Ukraine. The meeting coming as US-India relations are in flux after President Trump imposed 50% tariffs on New Delhi over its continued buying of Russian oil. And Pop Mart's new mini Labubu dolls have sold out across China. The new dolls went on sale at 10 p.m. local time, and all available inventory was gone before some people could even load the page fully. The dolls are expected to be in stock at Pop Mart's brick and mortar stores on Friday, and I'm sure Jonathan will be front of the queue. That's your Bloomberg Brief. Annmarie.
Thanks so much, Lizzie. Jonathan, no, but something new I just learned this morning. Matt Miller is a Labubu fan.
Well, I mean, my kids, Edna loves these Labubus, and when we were in Italy last month, she saw one at one of those trinket stores. I bought it right away and then figured out that it was a fake. So, but it was only like 20 euros.
Okay, all right. Oh, sounds like a lot, though, for a fake still. All right, up next in the program, back to some serious news. Trump versus Cook.
You had these mortgage receipts very clearly shown to the president, and he has the cause that he needs to fire this individual. We'll continue to fight this battle.
Ed Mills of Raymond James joins us next. You're watching Bloomberg Surveillance. Good morning. Futures this morning a little bit softer, but of course this is after the S&P 500 yesterday closed at a fresh all-time high. So we're going into this PCE report, the Fed's preferred inflation gauge, with futures just a little bit softer. Your 10-year yield this morning up almost 2 basis points, 4.22%. Under surveillance this morning, Trump versus Cook.
Mr. Pulte has deferred those allegations over to the Department of Justice to investigate them. What I will say is that you had these mortgage receipts very clearly shown to the president, and he has the cause that he needs to fire this individual. He laid it out in the letter that he provided to her and to the public as well. And so we'll continue to fight this battle.
Here's the latest. A hearing is set for 10 a.m. Eastern this morning on Fed Governor Lisa Cook's bid to keep her job while her fight with President Trump plays out. Cook's lawyers say an unintentional, quote, clerical error may be to blame for the mortgage dispute over which Trump wants her fired. Bloomberg's Tyler Kendall joins us now. Good morning, Tyler. What's the latest?
Yeah, hey, Annmarie, good morning. Well, as you mentioned, Lisa Cook officially filed this lawsuit challenging President Trump's attempts to oust her as a Federal Reserve governor. And as part of this, she also filed what's known as a temporary restraining order. And that's what we're going to be really focused on today. This would allow Cook to keep her seat, potentially even vote in that September meeting, while the broader issue of her firing plays out in court. That hearing is set for today at 10 a.m. Eastern. And Cook's broader lawsuit, though, argues that President Trump violated a federal law that does allow him to remove a Fed governor, but only for cause. That's Section 10 of the Federal Reserve Act of 1913. And Cook says that this does not constitute cause. The problem with cause, and we're going to be talking a lot about this over the next few days, is that it's not explicitly defined, though historically has meant to mean malfeasance or a neglect of duties related to the job. And if you ask the Trump administration, they point to these allegations of mortgage fraud. You had the White House press secretary yesterday, both to reporters and also in a written statement, to double down on this idea that President Trump was within his lawful authority. However, Cook's lawyers say that this does not rise to that level of cause. And we should also say that at this point, these are only allegations. No criminal charges have been brought. As you mentioned at the top there, we got perhaps a preview of the defense that we could expect from Cook's lawyers. They say these allegations are not true, but that if there were any errors, perhaps this could be related to a clerical error, and that Cook had no intent to deceive anyone, and that also there was no harm done. That is a legal standard known as materiality. And Annmarie and Matt, I bring that up because we are expecting intent and also harm to be two of those factors that the judge weighs in this case.
Tyler, thanks so much for that. Bloomberg's Tyler Kendall in Washington. Let's continue this conversation with Raymond James, Washington policy analyst, Ed Mills. Ed, thanks so much for joining us this morning. I want to pick up on one point Tyler talked about, for cause. If this goes up to the Supreme Court, how do you think they will look to define that term?
It's a great question, and I think that there is the question about the for cause and also the question about, is the Federal Reserve somewhat separate, something of a distinct entity? Justice Roberts has already said that it is. I also think when we're looking at this for cause, because there has not yet been an indictment, there has not necessarily been a finding of the courts. When is it up to the president to be the judge and jury in the case? And when is it up to the traditional legal system to be judge and jury in this case? I do think that there are major questions that are being raised about Dr. Lisa Cook, but it is a due process that is afforded to her before I think a lot of those issues are settled here, Annmarie. So I think that President Trump has had a number of wins in the courts removing individuals. I think he just has a much higher bar here because it is the governor of a Federal Reserve System that the Supreme Court has already said is different in their eyes.
I wonder about the timing here, Ed, because I don't doubt that she can get an injunction to keep her in her seat by the time September 17th comes around, and she probably would vote for a cut anyway, so that's not going to bother the Trump administration as she leans dovish. But February is a much more important date because the governors are going to have to confirm the regional presidents, and that's when the Trump administration would probably like to have a stacked board. Do you think the Supreme Court can give the president what he wants before then?
Yeah, Matt, you're making some really important points here because it is, when I look at the judge that this court has, this case has been assigned to, it is someone that Biden put on the D.C. federal court here. She has already struck down previous executive actions by President Trump. it's fairly reasonable to assume that this temporary restraining order probably goes in favor of Dr. Cook because of that. But, as you mentioned, I think it is also important to highlight that the monetary policy tilt of Dr. Cook versus what President Trump wants are more aligned than what you would think. So you're asking yourself, what is this about? Is it because he wants to have a 5-2 majority once Jay Powell steps down? Does he want that 4-3 majority as soon as kind of later this year, assuming that Marin is confirmed? He already has Waller and Bowman from his first term. This here is that majority. The Federal Reserve on years that end in 1 or 6 have to kind of codify what goes on in the regional Fed system. And so does he want to fundamentally alter kind of the way in which the Federal Reserve works with the regional Fed presidents and how the FOMC is constituted? If that's really the question here, Matt, that's a bigger question, and I think that's where the market so far hasn't really been disrupted by this event, but could get really disrupted if they think that the Federal Reserve is fundamentally being altered in the way in which they set monetary policy.
Ed, I wonder if Republicans care at all. I mean, when you talk to people on the Hill, when you talk to Republicans on the Hill, are they concerned about Fed independence? Because any economist will tell you that a country with an independent monetary policy will do better over the long run than a country without one.
Yeah, so I think they are, but I don't know if they want to have a fight with Donald Trump. One thing that I've highlighted for clients at Raymond James for years now is that the Federal Reserve, well, we're not under the illusion that they're completely independent. We're not under the illusion that they're not influenced by politics, but it is the one area when you go back to Trump 1.0, when you look at what happened during Biden, where their own party has said no to some of the selections of the president. During Trump's first term, there was a number of governors that he has supported that did not get confirmed. You go to Biden, Sarah Bloom Raskin, she was put up as vice chair for supervision. She was not confirmed. There has been a belief in Congress, and especially in the Senate, that the Fed is kind of the whole ballgame. If we lose confidence in the Fed, that's a destructive influence on our economy and our markets. And so they haven't been willing to go there. But because there is this kind of question about, did Dr. Cook do something wrong? President Trump has been putting up most of his nominees that have gotten confirmed. They haven't necessarily been willing to step back and push back against him. But if there was a major market reaction related to this, they would. If not, and if it's a traditional nominee that would replace her and there's a court decision, they would go along with that replacement.
Ed, what about Steve Myron? We have the Senate coming back next week. Do you think he will be expeditiously confirmed to then be at the Fed meeting in September?
Yeah, Annmarie, in D.C., we have two modes. It's glacial or overnight. So we're going to go into the overnight mode with Myron's confirmation. The Senate Banking Committee has already set the nomination hearing for next week. I'd expect probably a week after that he is on the board. This is a nomination that only goes until January 31st of next year. He's already gone through the Senate confirmation process. I think that's part of the reason why he was selected. So all the paperwork has been done. Every Republican senator has already voted in favor of him. This is as quick as you get for those factors. They want him in, and he will be in by that September rate decision.
Ed, thanks so much for your time this morning. Have a lovely Labor Day weekend. Ed Mills of Raymond James. I know that speed especially. It's really, really slow in Washington, D.C. until it happens almost immediately overnight. They stay up till 3, 4 o'clock in the morning because they have to get something done.
Yeah, I mean, they definitely put in the work when they need to. And they go home and do their campaigning when they need to. They do what needs to be done. There's this feeling that they do nothing, right? Because we have things like government shutdowns. But when that happens, they want that to happen.
That's actually something, it's a good point you bring up, because that's actually something there's going to be a huge fight in the next few weeks. We actually might have a government shutdown, likely potentially a continuing resolution will keep them aboard. All right, coming up on the program, Heath Terry of Citi Research on why the market may be underestimating AI, plus Lizzie Burden with your morning movers as Ulta raises its full year forecast, up more than 3% this morning. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. John and Lisa are off today. I'm Annmarie Hordern alongside Matt Miller. We are off a fresh all-time high. Yesterday on the close, we were north of 6,500 on the S&P. This morning, Matt, we're just pulling back slightly. Probably the market is just treading water ahead of all-important PCE data. Of course, that is the inflation gauge. The Fed looks at it 8:30 Eastern. And then at 10 a.m. Eastern, potentially another risk for the market. This court is going to be hearing this potential injunction when it comes to Lisa Cook. 10-year yield, not really caring about that drama.
I was going to say, that's not a risk because this market has shown it does not care about Fed independence for now. And I think everyone expects Lisa Cook to get an injunction and then the Supreme Court later to allow the president to fire her. But to me, the interesting thing is that NVIDIA was down yesterday and still we climbed to a new record high. So for one thing, you're seeing continued rotation, right? If you do RRG on the S&P on the Bloomberg, you can see that rotation. The other thing that's interesting is Jonathan Levin wrote a Bloomberg opinion piece yesterday pointing out that stocks like Walmart and Costco have incredibly high valuations, and they may be a bigger risk than NVIDIA. If you look at Costco's forward PE, it's more than 50, and NVIDIA's forward PE is only 40. So it's really interesting that the market's willing to give these premiums to some of these traditional businesses.
Yep, certainly a lot of premiums all baked in at the moment, and we haven't even gotten that Fed rate cut, which the market continuously just bakes in. Chris Waller overnight, once again, calling for the Fed to cut 25 basis points, Matt, and then saying basically if the labor report is so bad, he even consider a jumbo rate cut.
Yeah, he said to him, inflation is right around 2%, even though it's at 3%, right, which is 50% higher, and that he is back on team transitory. That's a direct quote, right, which was so widely mocked during the pandemic.
Air quotes.
Right.
Team transitory. Well, basically he's just saying is you don't consider sales tax. We don't consider sales tax at the Fed to be inflationary. We're not going to consider this what he believes is a one-time price adjustment when it comes to tariffs to be an inflationary spiral.
Right, but if sales tax had previously been 2% and then we quadrupled it or quintupled it, that might be, or sextupled it, right? From 2% to 15, like that's a big jump for the American consumer to handle.
Right, and we're seeing that in some of the individual movers today, like Caterpillar. Let's get more on those individual morning movers before the market open. Lizzie Burden has those for you. Hey, Lizzie.
Hey, Annmarie. Let's start with the winners, shall we? We kick off in San Diego with Petco, and those shares are currently up 15% in the pre-market, more than that, after it issued third quarter guidance that beat expectations and it nudged up its 2026 outlook. The company, of course, as you know, in the middle of a turnaround under the CEO Joel Anderson. The efforts focused on revamping stores and closing underperforming locations, and you got the shares down around 15% so far this year. Compare that with the 24% rise for its rival Chewy, so nice to get a bit of upside for the stock this morning. Next up, we turn to Ulta Beauty, the beauty store chain, of course, up almost 4% in the pre-market. It's also issued a raise and a beat, even as it's warned about a potential pullback from consumers. Interesting, given the demand for cosmetics has held up so far this year, despite the economic uncertainty, the lipstick effect, perhaps. And finally, to the losers, Marvell down nearly 15% in the pre-market. Its results nothing to marvel at. Data center revenue missing estimates and the revenue outlook below expectations. Our analysts pointing out, Annmarie, just how disappointing that is, given the strength of AI demand, given the capex spend from the hyperscalers, and actually a downgrade now from B of A. Annmarie, back to you.
Thanks so much, Lizzie Burden. On our radar this morning, a federal judge in Washington is set to hear Fed Governor Lisa Cook's lawsuit against President Trump later this morning. The suit would block Trump from firing her. The legal battle is seen as likely to end up being decided by the Supreme Court. And Matt, this is where I think things will get interesting. First off, unprecedented. So the Supreme Court decision is going to be incredibly important. They're going to be the ones that have to really define what for cause means. I keep going back to what the Supreme Court said in May in one opinion, which is the fact that, like the Fed, institutions like the Fed are quasi-private entities. Will they do that this time around? Or are they going to give the president more leeway in really defining what for cause means?
I thought Yesterday, you had a great guest on from Wolf Research who pointed out that this Supreme Court is going to be loath to try and tell the president what they think for cause means because they want him to be able to interpret that. They've given him at least 2/3, maybe 3/4 of the cases that have come before them so far this year, and they're likely to give him this as well. But it does look like Lisa Cook is going to get an injunction because this judge seems to be more friendly to
And
her.
you brought up a great point. That means if she gets an injunction, she will likely be able to continue her job, and she'll show up at the Fed meeting in September. And as you point out, she's a dove, and she's likely going to line up on doing something the president has been calling for since he became president in the second term.
By the way, we have a great function on the Bloomberg terminal. FDSP Go will show you, it's a Fed spectrometer, and it'll show you where each voting member and non-voting members fall on the scale of hawk to dove.
Awesome. Elsewhere this morning, German Chancellor Friedrich Merz saying a meeting between Vladimir Putin and Volodymyr Zelensky is unlikely to happen. This update contradicts earlier statements from the U.S. that the two leaders had agreed to meet. This story just continues to grind. I was in the cabinet meeting this week with the president and his cabinet ministers, and he was questioned about this because Sergei Lavrov, the Russian foreign minister, also said there's really no plans right now. And the president's kind of just saying they'll meet. He keeps saying they'll meet, but he's giving Vladimir Putin a lot of time here. So I think you have to start thinking about if he cannot get these two to the table, is he going to double down on the things like sanctions?
It doesn't seem likely. He hasn't historically challenged Vladimir Putin too much. Now, I think he's right when he voices concern that Putin is stringing him along. It does look like that's happening, but no one knows better than you. You've spent time with Vladimir Putin. You've spent time with the president. You've spent time covering the oil market, and I think that is really what this is about more than almost anything else.
I think what's interesting is that the Europeans are considering secondary sanctions on other countries that are importing goods. We saw the president do that when it comes to India. The 50% tariff rate on India went into effect this week. Speaking of tariffs, Matt, as of today, the U.S. has closed a tariff exemption that dates back to the 1930s that allowed for duty-free imports of goods valued at $800 or less. The change is expected to result in more than $23 billion in additional customs revenues and fees over a decade. So this is the so-called de minimis. And basically, they're closing this loophole. So you can no longer just accept a $100 T-shirt, a $15 T-shirt from Shein or Temu. And you're going to have to pay the tariffs on this.
Yeah. I mean, I wouldn't want to participate in the fast fashion industry because, I mean, it's horrible for the labor that makes those things. But I've ordered a couple of Arai helmets, one from Japan and one from the UK, that are $600 or $700 a piece. And I'm afraid I'm going to get hit with that tax when they come in.
I believe it depends on when they were shipped. So you potentially might not get hit with that tax. But when it comes to those fast fashion retailers, this is why when it comes to closing the de minimis loophole, there's actually bipartisan support. We actually saw work happening towards this during the Biden administration because this is really this gateway for some of these Chinese companies to just inject cheap goods into the U.S. market.
Yeah, I don't disagree.
All right, we're going to turn to tech now. Heath Terry, head of technology and communications at Citi Research, says, quote, first, AI analyst on Wall Street believes AI revenue will surge to $780 billion in 2030 from $43 billion this year. Heath joins us now for more. Heath, that's a massive jump. And if you think that's where it's going to go, is this market underpriced?
Look, that's the way we look at it. I mean, we are in the very early stages of this AI cycle, and really we think sort of posed for an inflection ahead of us. A lot of things that sort of matter to driving growth are about to clear in growth's favor. The bottlenecks that we've seen in capacity constraints, the model development advances that we're seeing, particularly around agentic AI. And then, of course, the biggest of those being what we think could be called AI squared, the idea that AI on its own can start programming AI.
So, I wonder, Heath, your take on what happens in China, because NVIDIA at first didn't give us a forecast for the third quarter. They had nothing in the second quarter. And then the CFO came out and said maybe $2 to $5 billion, but she's not really sure about the president's deal to get a 15% take of everything they sell there. And to me, it just seems like the Chinese Communist Party is willing to do a whole lot to make sure its companies don't buy our chips anyway. So what's your take on that whole story?
Look, I think you're seeing that kind of mindset from every country. China, certainly the countries in the Middle East, major countries in Europe and the US, of course. Everyone feels like AI is an important enough technology that you cannot just secede it to sort of the global winners, which in other cycles have always been American. And I think, the mistakes of the internet era for a lot of companies on a country basis, or a lot of countries on a company basis, of allowing the US companies to come in and sort of be their own local champions is something that no one really wants to make in AI. Now, that's a really hard thing to actually enforce for most countries. China can obviously do it. They actually did it very successfully in the internet era. I mean, there are no bigger internet companies outside of the US than those that are in China. And I think they want to make sure that they do the same thing when it comes to AI.
I noticed also yesterday that an analyst from eMarketer said, we have to see returns on these investments, and soon. And the threat is that these big hyperscalers who are spending 40% of NVIDIA's revenue, and forgive me that I'm heavy on NVIDIA, but they just came out with earnings, so it's occupying my mind, that these big hyperscalers may pull back on the margin in terms of CapEx if they don't start to see returns soon on the applications, on the AI applications that they're powering. What do you think about that?
Look, I don't think there's any chance of that, right? I mean, we go back a year ago, and you had the CEOs of Alphabet, Meta, Microsoft all get on their earnings calls and say some version of the risk of overinvesting is far less than the risk of underinvesting in this space. And then we fast forward a year later, and they've all said, you know what? Even though we believed that, we actually underinvested, and capacity constraints are still there. Microsoft in particular called that out on their most recent earnings. And so you don't see that kind of demand outstripping supply if the returns aren't there. And there have been a range of studies. MIT had theirs, which I think most people sort of misunderstood or didn't get past the headline. IDC has had one that said that CFO or CIOs are getting 3.7x for every dollar they put into AI. So there's a lot of work being done around this. We obviously did a lot of work around this in the 120-page report that we published earlier this week. And the returns, and admittedly, they're early returns, but the early returns show that this stuff is working at the enterprise level.
Heath, something that Jonathan has been bringing up a lot when it comes to the AI story, I'd love to get your take on is, do we have the power, the electricity needed to run this industry, and especially given the outlook you have in your research?
Yeah, look, this is something we cover a lot. The team at Citi that covers the industrial space and the energy space has spent a lot of time on this. And look, there are going to be bottlenecks. But here's the, for lack of a better term, kind of the sad reality of this is that when there are shortages, when there are bottlenecks, capacity and supply moves to the highest value usage. They move to the highest bidder, for lack of a better term, and that's going to be AI. And so, yeah, there are going to be shortages, there are going to be bottlenecks. But if you're in AI and you're building a $20 billion data center, you're far more likely to get the equipment you need, the power you need, than the person who's next further down that line on that list. And so, there will be bottlenecks, but I don't think you're going to see them in AI, and I don't think that they're going to be the things that sort of slow development here.
Heath, thanks so much for your time this morning. Heath Terry of Citi Research. Want to get you an update now on stories we're watching elsewhere. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, Annmarie. European leaders have referred Iran to the UN to re-up sanctions against the country after Iran failed to comply with demands over international inspections of its nuclear program. Iran has threatened to leave the Nuclear Non-Proliferation Treaty if UN sanctions are resumed. Elsewhere, Caterpillar shares are trading lower in the pre-market after the firm warned that the US tariffs will squeeze margins more than expected. The company now sees a hit of up to $600 million this quarter and as much as $1.8 billion next year. Caterpillar said that its full-year profit margin will land near the bottom of its target range. And the CDC has a new acting director after President Trump fired longtime government scientist Susan Monares. She'll be replaced by Robert F. Kennedy Jr.'s current deputy, Jim O'Neill. The move comes as a key advisory committee is expected to issue new recommendations on immunizations. Kennedy recently reshaped that committee, adding several vaccine skeptics. And that should be my brief. Annmarie.
Lizzie, thanks so much. Up next, new duties taking effect.
The de minimis rules, just as a bit of a reminder, $800 is what the U.S. has said. You don't have to previously have to go through customs duties, but that accounts for about 4 million packages each day.
Former NEC Deputy Director Everett Eissenstat joins us next. You're watching Bloomberg Surveillance. Good Good morning. Equity futures this Friday morning, a little bit softer as we head into the all-important PCE inflation data coming out at 8:30 Eastern time. We'll have full coverage of that right here on Bloomberg Surveillance. But of course, all of this with a grain of salt because yesterday the S&P 500 had a fresh all-time high. Under surveillance this morning, new duties taking effect today.
The de minimis rules, just as a bit of a reminder, $800 is what the U.S. has said. You don't have to previously have to go through customs duties, but that accounts for about 4 million packages each day. So a lot of these businesses will never have had to go through a customs process. So it is likely to introduce quite a bit of friction. Any sort of change in both the friction in terms of the time of processing, but also the additional cost can really mean the success or really pivoting of those businesses going forward.
Here's the latest. President Trump is bringing an end to the de minimis exemption, which allowed merchandise shipped to the United States valued at $800 or less to be tariff-free. Everett Eissenstat, the former NEC deputy director, writing, a number of countries, including Mexico and the European Union, are suspending postal package shipments to the United States. This is a significant change for online shoppers and retailers. Everett joins us now. Everett, thank you so much for joining us this morning. I feel like politically this was a long time coming, having covered the Biden administration and the Trump administration. But how big of a deal is this going to be when it comes to trade with the United States?
Well, this is going to be a big deal. As you noted, this has been coming for a long time. There's been some concern over the use of de minimis and that it had been used to circumvent U.S. customs laws and to bring in illicit products. There's all kinds of debate around this. There was all kinds of debate about how to manage the program. Ultimately, President Trump said, look, we're not going to do that. We're just going to stop this program, and we're going to put in place to collect these duties. A lot of companies and consumers have become reliant upon this process, have been able to order products from overseas, bring them in with very little duties and fairly rapidly. And that's going to end today. And I think you're going to see a lot of households are going to be surprised at both the costs and the complexity involved in getting their products from overseas.
Well, we have one of those individuals sitting around the table this morning. Matt was just telling us how he has 2 helmets coming from Japan, I think one from the European Union, that he might get hit with this tax because they were just under $800. Given that's the case, do you think there's going to be a lot of pushback and potentially we could see this administration, I'm not trying to be cute here, but taco?
No, I don't think so. Not on this one. This one, there was bipartisan support for revising de minimis for many, many years. And I actually had the honor of working on this statute when I was on Capitol Hill as the chief trade counsel. So I recall why we made the modifications at that time. The idea was to relieve, the Customs Service of the burden of enforcing small packages, bring them up to do some more complex enforcement mechanisms. And there was a trade-off, right? And to do that, the shippers had to meet certain criteria. The packages had to meet certain criteria. It was doing very, very well. As you noted, many, many packages have come in. But the frustration over the program has been long brewing and bipartisan, particularly as it related to China, which has been terminated quite some time ago. But now it is global. And there's a lot of companies and customers and even foreign postal services out there struggling with, well, how are we going to implement this? What does this mean? Who's going to collect the duties? What is the duty going to be? And the helmet analogy you made is just one example of many, many stories I suspect we're going to be hearing over the next several weeks.
Well, we've been talking about the fast fashion industry, which is notoriously bad for the environment and horrible for the labor, that creates those products. That's why this has, I think, bipartisan support, as Annmarie was saying earlier. But are you worried that postal systems are going to be experiencing real disruption here? Are we going to see some trade issues in terms of shipping because of this?
No doubt. I'm quite confident of that. I mean, when you make a change of this magnitude, It's global. It's going to take some time to sift it out. It's going to take shifting resources around the world to come into compliance with these new requirements. So, yeah, it's going to be burdensome. It's going to take some time. That doesn't mean it won't work, but it's going to take time. You can't make a change like this overnight and expect everything to continue to move just as smoothly as it is. And your example on these fashion shipments is exactly one of the cases in point, where you have an industry that was built up around this concept that really I'm not even sure is will be able to resolve itself and survive as it did in this new environment. So it's a pretty important change, and one that's going to filter through pocketbooks and companies for quite some time.
Everett, I want to transition to autos here because you have a fantastic resume for that. You worked for President Trump at the NEC, and then you worked for General Motors, which makes some of my favorite gas engines, a 6.2-liter naturally aspirated V8, as well as some of the best EVs out there. The EV Sierra is an incredible truck. What do you think about the cancellation of EV tax credits from the big, beautiful bill? Because clearly these automakers have had to invest billions in making EVs, and electric is going to be the powertrain of the future. So what happens when we turn off that incentive?
It's so huge. And, that's just one part of that greater complexity when it comes to electric vehicles. It's not just a tax incentive. It's what are the emission standards? What are the fleet requirements? There's all kinds of different reasons that a company will choose to produce an EV over, say, an ICE or an internal combustible engine. So the tax credit's meaningful. It's important. It's not determinative, but some of the other elements are. And so the president's also modifying the mile per gallon emission rates. He's looking at changing some other things. So it's really giving mixed signals to the industry. And for industries that thrive on long-term predictability, massive capital investments, looking at timeframes, 3, 5, 6, 7 years out, this is really, really difficult to plan in this environment. And you made a really good point. The EVs around the world are surging. They're primarily because China is subsidizing the industry and pushing out a lot of product that they cannot get into the United States. But the EV is going to become the dominant vehicle in the future, and the United States has got some work to do to catch up to that.
We also have Everett problems when it comes to tariffs because we're giving a 15% flat rate to Toyota and Honda out of Japan and General Motors and Hyundai in South Korea, but Ford has to pay big taxes on aluminum, big taxes on imported parts, big taxes on Chinese magnets, to the point where it costs more to produce those vehicles in Dearborn than it does in Seoul. Does that make sense to you? How do they solve that?
That's an anomaly. We're going to have to see how that's resolved. But I doubt there was anybody who planned that out and said that's exactly how we want this to land. I think some of these pieces are moving at different paces at different times, and sometimes bring them all together into kind of a coherent package is very, very difficult. It is going to be tough to produce in the United States, but at the same time, the U.S. market is really the only market around the world where car companies can sell their vehicles profitably. There's a lot of things we can do to make the system here more efficient. There's a lot of things we can do to help our domestic manufacturers, but we need to take those into account.
Former NEC Deputy Director Everett Eissenstat. Matt, I was waiting for you to bring up cars. Took you 50 minutes into the 6 a.m. We're back with another Bloomberg Surveillance next.
Inflation is very, very important to the market.
The inflationary backdrop for the US right now is anywhere near as egregious as some commentators would say.
I am more worried that the rise in inflation caused by the pass-through of the tariffs, it could end up being more persistent.
I expect a Fed that will be constantly data-driven and may have to pause to recalibrate where the economy is moving.
Ultimately, we are going to have to see the data. It's going to be very data-dependent.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
From New York City for audience worldwide, good morning. This is Bloomberg Surveillance. Today, I'm Annmarie Hordern alongside Matt Miller. John and Lisa are off. You can get a sense it is a summer Friday, especially a Friday before the Labor Day long weekend. doesn't mean we don't have an important Friday ahead of you. 8:30 Eastern, that's where we're going to get the all-important PCE inflation gauge. Of course, this is what the Fed looks at. And then at 10 o'clock, Matt, we're going to get this hearing on Governor Lisa Cook. So when it comes to what is going on between data and also personnel and policy, it is all happening today in terms of Washington, D.C. First up, though, when it comes to the inflation gauge at 8:30, do we even need to care? Governor Chris Waller yesterday basically said that he's on team, and he put in air quotes, transitory when it comes to the tariff impact on inflation.
Right, because we're expecting to get PCE, core PCE at 2.9%. Now, to him, that's 2. Because he sees it as transitory, right? And he is already invested in cuts. He may even see a need for a jumbo cut depending on what happens with the labor market. But I think the University of Michigan data could be interesting in that we get inflation expectations that people on the Fed really consider important. I know it's the U of M.
Who important? It was Governor Waller, who basically felt like wrote Powell's speech at Jackson Hole, who sat around this table and said that survey, because it is highly politicized.
Yeah, but they break it down so you can see what Republican expectations are and Democratic expectations are. And for a long time, they were going in opposite directions, but now they've started to come back to. You see what I'm doing here? You seen top here?
Let's go into what Governor Waller said, because I think you brought up a good point, opening the door potentially for a jumbo rate cut. I don't believe that a cut of larger than 25 basis points is needed in September. That view, of course, could change if the employment report for August, which is due out a week from today, points to a substantially weakening economy and inflation remains well contained. If we get a big downside on the labor market report, do you think that puts 50 on the table?
Well, I'm not sure about that because we're not yet pricing in a full cut. Right now, I think if you look at the WIRP function on the Bloomberg, it's only about 85%. And even when we did get those downward revisions, which are horrible and showed over the last 3 months, only 35,000 jobs were added each month on average, we still didn't get up to a full 50, but it definitely pushes us in that direction.
Let's take a look where markets are this morning. No drama, as Jonathan would say. We are a little bit softer on futures, but of course this comes as yesterday a fresh all-time high, 6,500 yesterday on the S&P 500. 10-year yield up almost 2 basis points, 4.22%. Matt, you've been bringing us back to this point, which I think is really important. If individuals in the market are really concerned about Fed independence, wouldn't this yield be much higher? And that story is going to come into focus today at 10 o'clock.
Yeah, I think there must be some technical answer to why we haven't seen yields rise higher. You guys had Gita Gopinath on yesterday, and she was saying, well, everyone must have faith in Fed independence. That must be what it is. But I'm not sure everyone does have faith. So maybe it's a liquidity story?
I think people are just waiting for the courts to decide, and that's going to be a process. Coming up on this program, Katy Kaminski of AlphaSimplex, a stock slip ahead of key inflation data, Krishna Guha of Evercore with the future of Fed independence hanging in the balance, and Gene Munster of Deepwater Asset Management on the AI race. We begin this hour with stocks drifting lower ahead of core PCE data. Katy Kaminski of AlphaSimplex Group writing, quote, equity market sentiment has been drifting more positive as we seem to have passed peak tariff uncertainty. The potential for Fed rate cuts has also boosted equity market trends. And Katy joins us now. Katy, it feels like there's a lot of risk potentially still in this market, but markets keep grinding higher. Another fresh all-time high yesterday. Why? What's behind this?
Well, I think the truth is the markets have been steady as you go this month. And as I noted, that the uncertainty is just not moving the markets around as much as we saw before. In general, things have been drifting more positive. I think the rate cut possibility has really boosted the market this month. And you're also seeing positive moves across a much broader set of equities, which is also encouraging. We also see good news out of Asia and some positive news that kind of continues to be a good drift into the end of the summer, I would say.
Katy, I want to ask you about AI, about NVIDIA, about chips, because you studied electrical engineering, because you have your PhD in operations research at MIT. What do you think about NVIDIA, especially in light of the fact that the Chinese Communist Party seems to want its companies to buy no more chips from the U.S. producer? And considering their earnings report yesterday, the outlook didn't seem that great.
This is a good point. I was actually kind of surprised because the market seemed to shrug off some of the not as good news for NVIDIA. I think some of it may be sort of overall optimism for the space, but you are right. There are headwinds against NVIDIA, particularly China, which is such a big part of that marketplace. So I think, truthfully, we don't know enough yet to understand really how those dynamics will play out. And trade wars have also made that much more complicated, much more unclear. But it's true that there's a buzz, and the direction for AI has been continually strong. So I think, the market still thinks that we'll sort this out, and that, these are sort of the stocks that we need to hold going forward. I think the broadening of the market this month helped a little bit, because if you think about how concentrated we are in that theme, it is a risk factor for most investors.
I was lying in bed last night thinking about the all-time high that we hit on the S&P and the fact that NVIDIA was down, right? A $4.3 trillion company that's worth like 10% of the index is down. And so I got up and I logged onto Bloomberg and put in the RRG function, relative rotation graph, on the S&P, and I see that consumer discretionary is coming up. And you are seeing a rotation out of like these Mag 7 or Great 8 companies into the rest of the 493. Does that continue?
I think so. I mean, a lot of that narrative really comes from the rate cut expectations. And I think that is really where that's a sector, anything outside of the top 7 has really struggled for quite some time. I think the biggest data point for me is taking a look at how well the Russell 2000 has done this month versus the NASDAQ. And that's quite a spread, possibly up to 5%. So you're really seeing, this pivot and rotation, and that's a positive sentiment for US domestic equities. So I think that could be something that could provide some breadth when we have a lot of focus on AI and a lot of focus on tech.
Are you surprised about that rotation, given the fact that we now, for the most part, have final tariff rates, and that's going to hit some of these companies in a big way?
Yeah, that is actually the thing that I'm the most concerned about. And I think the de minimis news today and sort of thinking about that, a lot of factors are inflationary right now. So eventually this is going to hit a large number of companies. We have seen some indications in the fixed income markets where, you're seeing short pressure on long-term bonds and really kind of weak signals. So to me, that's one of the first places you'll start to see some potential, putting your view in the market. If you think inflation is a problem, then you stay away from long-term bonds. So I think that's the market I'm following first as a potential indicator for where that eventual stress may come.
Do you think long-term bonds are concerned about inflationary pressures or about Fed independence?
I think both. That's a good question, because Fed independence definitely affects the inflation narrative as well, because with a less independent Fed, maybe long-term implications are less in focus. And frankly, with lots of different aspects of the trade policy being inflationary in nature, you're eventually going to see that in long-term cash flows. And I think we'll continue to follow those long-term yields. They have actually gone up more this year than short-term yields. And I think that's a place where people naturally go to, express their view on inflation. So I think we'll have to watch those and see how they develop, especially if we get a big rate cut at some point later this year. That could really spur a potential trend.
You have noted that September is bad. Another great function on the Bloomberg terminal, SEAG Go. If you look at seasonality, over the last 30 years, September is the absolute worst month for stocks. Do you think traders and investors take this into consideration when they're trading stocks?
I mean, I think they definitely do. I think one of the challenges is, and we see that in our space, August tends to be a tricky month for trends, for example, and that hasn't been the case. So I think there's always exceptions. I think this year is particularly notable because we've had the quiet period. We're coming out of the recent Jackson Hole summit, and basically September is a time where I think people reassess the data and they say, wait a minute, how do we put this together to get into the end of the year? So it is possible we could see some correction of this very positive risk sentiment that we've seen.
When they reassess the data and we look towards September, do you been paying attention to the CPI print given what Governor Waller said last night?
I would definitely say I'm still paying a lot of attention to it because a shock in that will still matter a lot. But I do think we're seeing more and more evidence that the Fed is shifting towards lower rates. What I'm more concerned about is how extreme that is. And if it's much more aggressive, that's what could actually spawn a much bigger spike in inflation. So I do think that you still watch it, but obviously this narrative has made that particular number much more difficult to read and understand what that means, how that's gonna move the markets, I mean.
Katy, thanks so much for your time this morning, and happy Labor Day weekend to you. Hope you enjoy the long weekend. Katy Kaminski of AlphaSimplex Group. We're going into, Matt, it's a long Labor Day weekend, but there's a lot of data that you have to get through today, as well as this overhang of what is going on between this fight between Governor Lisa Cook and the White House.
Yeah, and you probably don't want to be holding risk assets into this long weekend, especially as we're coming up to September. When we were talking to Nick at the very top of the show, he pointed out that equity markets typically rise, right? Up and to the right is the trend. And if you look at the seasonality, only 3 months over the last 30 years have averaged losses, and September is the worst one, down 0.8%.
I'm looking at it right now. Thanks so much for sending me that function. Matt Miller with the functions this morning. We're getting you an update on stories elsewhere. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, Annmarie. Federal Housing Finance Agency Director Bill Pulte has filed a second criminal referral against Fed Governor Lisa Cook. The new referral relates to a property in Massachusetts following a complaint alleging that Cook fraudulently listed homes in Michigan and Georgia as her primary residence when she obtained mortgages in 2021. Elsewhere, Brazilian President Lula plans to hit back on Trump's 50% tariffs. Sources telling us here at Bloomberg that Brazil is starting the process to retaliate against the tariffs. Brazil's government has 30 days to assess a potential response. And Jannik Sinner has continued his strong start at the US Open with another straight set win. Women's number 2 seed Iga Swiatek struggled a bit but battled back to advance to round 3. And the singles title hopeful American Coco Gauff won in the second round, setting up a potential showdown with Naomi Osaka. And that's your Bloomberg Brief. Annmarie.
Lizzie, thank you so much. US Open fever right now in New York. You actually missed last night to come join me this morning.
My boys, my dogs invited me, and they had actually front row seats, but I said no.
You're committed to
I'm
Bloomberg.
doing surveillance with Annmarie Hordern. Yeah.
All right, well, hopefully you can get to go before the US Open ends. Up next in the program, a battle over sufficient cause.
You had these mortgage receipts very clearly shown to the president, and he has the cause that he needs to fire this individual. We'll continue to fight this battle.
What does for cause mean? Krishna Guha of Evercore joins us next. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. We are waiting for, of course, this morning, that all-important PCE report, the Fed's preferred inflation gauge. Forecast to show excluding food and energy rose 2.9% in July from a year ago, fastest pace in 5 months. But guess what? Governor Christopher Waller says he thinks inflation right now, or the tariff impact on inflation, is, quote, transitory. So you have to ask, does a hotter than expected PCE take a rate cut really off the table when it comes to September? Under surveillance this morning, we'll be debating that all morning. But under surveillance this morning, another debate, a battle over, quote, sufficient cause.
Mr. Pulte has deferred those allegations over to the Department of Justice to investigate them. What I will say is that you had these mortgage receipts very clearly shown to the president, and he has the cause that he needs to fire this individual. He laid it out in the letter that he provided to her and to the public as well. And so we'll continue to fight this battle.
Here's the latest. A hearing is scheduled for 10 a.m. Eastern this morning on Fed Governor Lisa Cook's bid to keep serving while her battle with President Trump plays out. Cook and her lawyers argue an unintentional clerical error may be to blame for the mortgage dispute at the center of her dispute with the President of the United States. Bloomberg's Tyler Kendall joins us now. Good morning, Tyler. So what should we expect at 10 a.m.?
Yeah, hey, Annmarie. Well, there is a lot to dig into, but the first matter of business is going to be the fact that Cook is seeking something known as a temporary restraining order. That would allow her to be reinstated into her seat, potentially vote at that September meeting, while the broader issue of her firing plays out in court. And Cook's lawyers argue that if she's not able to be reinstated during this time, it would cause irreparable harm, not just to Cook, but to the Federal Reserve as an institution as they head into their next rate cut meeting. Now, importantly here, Cook's lawyers are arguing that President Trump violated Section 10 of the Federal Reserve Act, which allows him to fire a Fed official if there is sufficient cause. And I bring up cause because this is going to be this one issue item that we pay very close attention to as this plays out in the coming days. Cook's lawyers say that there is not sufficient cause here, but as you mentioned, they did offer a potential defense yesterday when they filed these court documents, saying that these allegations of mortgage fraud are not true. But if there are any errors, perhaps it was a clerical error and that Cook did not intend to deceive anyone and that she did not cause any harm. I bring up intent and harm because those are two factors that the judge is expected to weigh. Annmarie and Matt, if you ask the White House, they are doubling down on their pressure campaign against Lisa Cook, saying that this is well within President Trump's right to fire her.
Tyler, thank you so much. And of course, you'll be there the entire morning outside the court. That expected to happen at 10 a.m. Let's continue the conversation. Krishna Guha, Evercore ISI Vice Chair and Head of Central Bank Strategy, joins us now for more. Krishna, thanks so much for joining us this morning. Do you have an understanding of how the court will define for cause in this case?
So I'm not an attorney. I'm an economist, and so I certainly don't want to mislead your viewers by offering legal expertise here that I don't have. What I will say, of course, is that the for cause protection and the idea that this establishes a high standard before a president can consider removing a Fed official is central to our understanding of how central bank independence operates in the U.S. So there's a lot at stake in this litigation.
Krishna, you're head of central bank strategy at Evercore ISI as well as vice chairman. And then I wonder what you think about inflation. We're looking for PCE to come in at 2.9%. We had core CPI at 3.1%. We had core PPI at 3.7%. And yet, Chris Waller says it's close enough to 2. Do you agree?
I think what's important here is that the inflation that we really care about is the second round inflation. It's the risk of inflation persistence. And no one, as a matter of theory or practice, thinks that the central bank should be directly responding to the first round effect of tariffs like a tax mechanically on prices. The issue is what pressure does that, if any, impart to underlying inflation dynamics? That's the second round question. And so I'm less focused on the individual month's inflation pass-through from tariffs. That's the first round mechanical stuff. But I am trying to assess what the risks are of inflation persistence and balancing those against the risks to the labor market. I actually think the conditions likely have been met for an initial cautious step down towards a more neutral rate. But I also think that the Fed should be very careful about signaling what follows from here and making it clear that it'll take the time it needs to assess the incoming data and judge whether, for instance, by December, the case for another cut has or hasn't been met.
Well, what if the Fed didn't, Krishna, take the time it needs? What if the Fed wasn't as thorough? What if the Fed was stacked with Trump appointees who just wanted to do the president's bidding? Would you buy then 10-year treasuries? I mean, does 420 make sense to you?
So I am concerned about the outlook for central bank independence, and I'm concerned about the Cook affair in that context. Obviously, if the president is able to push Governor Cook out, then that accelerates the time frame over which his nominees may acquire a majority on the Fed board. And that's, as you know, that then raises questions as to whether we might see an unprecedented effort to deny certain Reserve Bank presidents renewal, again, without cause. but also that the move against Cook based on allegations that have not yet been charged or proven in court or established by any kind of quasi-judicial process essentially weakens the protections that future Fed governors, by the way, including the people who President Trump puts in place, will have in the event that they have to make decisions in the future that this or a future president doesn't like. So this does absolutely all bear then on how you think about the outlook for policy and what may happen to bond yields. I personally feel that the market is likely underpriced for the risk that we could see a more of a break in Fed institutional practice and potentially the conduct of monetary policy over the next year or so as the Fed board transitions and as the administration attempts to acquire more authority over who gets to determine when four-cause conditions have been met.
Bill Dudley and Lael Brainerd agree with you. We spoke to both of them this week in terms of the market reaction. What kind of, I guess, yield should we see, say, on the 10-year if the market was really taking into account that this could be more of an erosion of Fed independence?
So I think what you see at the moment is that the bond market is not really quite sure how to interpret, first of all, the actions relating to Cook. And secondly, that the market is wary of shorting bonds aggressively in an environment in which, per Governor Waller yesterday, we could discover soon that the last 3 payroll months were negative. Right, once all the revisions are in. These are not necessarily the macroeconomic conditions in which you would want to ramp yields. But I would say that if, and we're still dealing in a probabilistic and uncertain environment, but if we were to get further confirmation over time that the Fed is losing independence, and if this resulted, as historically generally it has, in a central bank becoming more structurally dovish, then I do think at some point you would likely see a substantial response in the bond market. The issue, of course, is when and under what circumstances would that happen. I think it's hard to predict and certainly hard to say with any confidence that adverse bond market reaction would come immediately.
Krishna, really smart stuff. Thank you so much for joining us this morning. Krishna Guha of Evercore ISI. And he brings up a good point, Matt. There's really 2 different things the market has to focus on. One is these allegations, and that needs to play out in its own due process. And then, of course, this question of whether or not the Oval Office is exerting way too much pressure on the Fed.
Right. Well, I think the Supreme Court is going to say that the president, because he was elected to run the country, is going to be allowed to decide what cause means. In terms of the allegations, I mean, is that really going to play out?
Well, it likely, potentially will. If there's an investigation, that's something we're going to have to
I
watch
wonder what the penalty
and
is
cover.
for that kind of
clerical
error.
The intent is going to be very important. Coming up on the program, Margit Brandt of Premier Estate Properties on concerns of a wealth flight from New York City. Plus, Lizzie Burden with your morning movers, including Caterpillar. Look at the stock this morning, warning of a larger than expected tariff hit, down 3%. You're watching Bloomberg Surveillance. Good morning. Welcome back to Bloomberg Surveillance. It definitely is a Friday morning with Matt Miller and myself, with John and Lisa off today. Markets this morning, very much just softer a touch, because yesterday, Matt, we had, of course, an all-time high, 6,500 on the S&P 500. Bond market, really, as you've been saying, shrugging off any concern there is in terms of Fed independence. We're looking at a 4.22% on the 10-year yield.
Yeah, also interesting you don't see more weakness in the euro, considering what's going on in France right now. I thought the market would be more concerned, but I guess the dollar weakening at the same time puts them in the same situation.
2 hours away from the cash open, where we want to get you some morning movers this morning with Lizzie Burden. Hey, Lizzie.
Hey, Anne-Marie. Let's start with the losers this time, shall we? We go to Caterpillar. Those shares down about 3% in the pre-market. This after the company warned that it's expecting a tariff impact of up to $1.8 billion this year, higher than it had guided earlier this month. And of course, it's important because this is one of the world's biggest makers of machinery for mining and construction, so it could have knock-on effects for those industries. Next up, we turn to Ulta Beauty, up more than 3% in the pre-market. The beauty store chain is showing a raise and a beat, even as it's warned of a potential pullback from customers. And that's interesting given that the demand for cosmetics has really held up so far this year, despite the economic uncertainty. So maybe the cracks starting to show there. Finally, Alibaba, its US listed shares up nearly 3%, more than 3% now in the pre-market. The Hong Kong listing, though, had dropped into the red, but American traders focused on its reported surge in revenue from China's AI boom, even if it saw a drop in profit because it was aggressive competition with the likes of JD in the e-commerce space. But also interesting to note, Anne-Marie, the Wall Street Journal writing that it's planning to create its own AI chip to try to help China fill the Nvidia void. So we'll keep an eye on that. Anne-Marie, back to you.
Thanks so much, Lizzie. That last story, Matt, incredibly important. Front page of the Wall Street Journal this morning. Alibaba creating this AI chip to fill the Nvidia void.
Yeah.
This comes back to the question that even if the U.S. government is going to allow even the highest level chips into the Chinese market, will China want their firms to keep buying Nvidia, or do they want them to get addicted to their own hometown heroes and their own technology?
Yeah, I think the Chinese Communist Party has, on a couple of different occasions, given a signal that it does not want companies in China buying NVIDIA's H20 chips. And the interesting thing is, historically, China has had no problem just stealing IP from other manufacturers, international manufacturers, and making clones of that technology. And I don't see why they wouldn't do it this time. It's going to be expensive. It's going to take a lot of a lead time, but it's definitely going to happen.
Well, that's been the whole concern on why they've put export controls on a number of these NVIDIA chips. On our radar this morning, so what else we're watching? A federal judge set to hear Fed Governor Lisa Cook's bid to temporarily block President Trump's from firing her. Cook's lawyers are suggesting a, quote, clerical error is behind the mortgage dispute that has Trump pushing for her dismissal. So this is going to happen at 10 a.m. time. Likely, many people expect there to be an injunction. Likely, that means she can continue working. And Matt, to your point, that means she will get a vote in September at the Fed meeting.
Right. And I think her vote is going to please the president. So it's in a sense, it's ironic, if I'm using that term correctly, that the president is going after a dove. Right. I mean, right. And also, if they decide to stack the board of governors and take out some presidents, they'll go after Goolsbee first, and he's a dove as well. So.
Yeah, so it's looking very dovish, at least for 2026. I guess that's the take. What really is going to be the question for this case is what constitutes for cause. I keep going back to what the Supreme Court said in May. The Fed is a private, semi-private, quasi-private entity. They're inoculated from any political pressure. Does that stand? Because and you look at what the Federal Reserve Act, it doesn't really define what for cause means.
Right, and it's completely unprecedented. And this is why I think, after watching Bloomberg Surveillance every morning, that the Supreme Court is going to defer to President Trump on this issue. They have done that in so many cases this year, and I can't imagine why they wouldn't in this case as well. Say that the president is the one who gets to decide what for cause means, and he knows a thing or two about falsifying business records.
And mortgages. He's a debt guy. Elsewhere in Washington, D.C., the CDC has a new acting director after President Trump fired former head Susan Monterez. She'll be replaced by Robert F. Kennedy Jr.'s current deputy, Jim O'Neill. The White House saying Monterez was fired because she was not aligned with Trump's agenda. And around the world, Russian leader Vladimir Putin and Indian Prime Minister Narendra Modi are set to meet in China with President Xi Jinping Sunday. The summit comes as U.S.-India relations are in flux after President Trump imposed 50% tariffs over New Delhi's buying of Russian oil. And this has really sparked a huge debate, especially in India. Recently, we had on Bloomberg TV Peter Navarro, and he actually called the war in Ukraine, quote, Modi's war, because of how much crude India has made off of this war. They're bringing in Russian cheap crude, they're refining it and basically selling it back to places Russia used to sell to, like the European Union. And what we've seen, though, with this trade fight is Modi leaning in more to the BRICS And even Xi Jinping sending a secretive letter to Modi saying maybe we should start relaunching of bilateral ties. So I think this summit's going to be really interesting.
I mean, this is your wheelhouse, right? The oil patch, Putin, and I mean, I might call it Merkel's war. I think it's so fascinating that the EU has financed Moscow to such an extent and did nothing when Putin moved to annex Crimea and continues to buy refined oil products from countries like India, despite the sanctions that they put on.
Not only that, I mean, China, of course, is the biggest player here when it comes to imports of Russian crude. But Europe is also still directly buying from Russia. It's interesting you say that about Angela Merkel, because that was Trump's big fight in 1.0. He was vehemently against Nord Stream 2. And his whole point of NATO, why are we paying into something if you are going to continue the purchase of Russian crude?
No, I was in Berlin, and his energy secretary, Dan Brouillette, made a number of trips to try and convince the Germans to buy LNG from the U.S. instead of funneling money directly to Moscow, and they refused time and time again.
Trump won. They called it freedom molecules. That was the branding of trying to get more LNG into Europe. All right, we're going to take a different turn today, turning to real estate. Political uncertainty in New York is pushing a number of wealthy New Yorkers to Florida. New York Governor Kathy Hochul even saying, quote, "I don't want to lose any more people to Palm Beach. We've lost enough," when she was asked about raising taxes. The migration driving up demand for homes in West Palm Beach. Joining us now is someone that knows a lot about that is Margit Brandt, real estate advisor of Premier Estate Properties. Thank you so much for joining us. You're in New York.
Yes.
So this is exciting. You have seen this financial migration. Can you explain to us what's different now? Because we really saw a lot of this under COVID.
Of course. First of all, thanks for having me. I'm a New Yorker. I grew up here. And I think what's different this time is we're seeing a lot of organic momentum. First it was with the 2017, tax implications in New York, followed by COVID. And then after COVID, we sort of saw this change where people were opening their businesses in Palm Beach. And it was sort of like, Wall Street South from 2022 to 2024. And now in 2025, Mamdani kind of seems as, the likely, winner of the New York City mayoral race, kind of seems to be spurring further interest, specifically in the summer, which is typically a slower time for us, in July and August. But we're seeing some tailwinds.
Right, because most Palm Beachers are coming up here.
Of course, yeah. But just, we're definitely seeing some tailwinds from this New York City mayoral race.
So when it comes to Palm Beach specifically, and those New Yorkers coming down, are they still keeping a foothold in New York, or are people really selling everything in New York and fully relocating to Florida?
So what's different now, as opposed to even like 5 or 6 years ago, is, there's been billions of dollars. I mean, Steve Ross, the king of New York, is now, throwing billions of dollars into schools, into condos. And so we sort of have the infrastructure into schools. We have the infrastructure now to accommodate full-time moves. So to answer your question, what I'm seeing is that a lot of the big hedge funds are moving their businesses to Palm Beach. They're establishing residency. They're establishing Florida for tax purposes as well. And they're moving their people there because it's really sort of become this mini Miami in downtown West Palm. So it's a place of productivity and not a place where people go to retire. We have a very good friend and client who runs a major hedge fund, and he polled his people, and 30% of them were open to a move to Palm Beach or Miami. So I think that's an interesting statistic that 30% were open to making the move to Florida.
It's interesting you bring up West Palm because I feel like through the years, I've seen just every time I go down there, there is a new construction site.
Yes.
Big time businesses. So are prices going up? Are people being priced out?
I think that's false. But what I will say is that I look at Palm Beach as either a lifeboat or a hedge, right? And in terms of a lifeboat, you don't want to wait till the ship is sinking until you come and reach out for help. And then in terms of a hedge, I mean, you guys, it's not rocket science. You follow stocks all day here, right? And everyone always says, oh, the prices couldn't go up further, or there will be a crash, there will be something where the prices stop. But if you look from 2017, to COVID, to the, businesses moving down there, this Mamdani thing is just another spur. So I think that the proof is kind of in the pudding and where the prices have been going. And the pricing remains strong because we're a small island. If you look at Palm Beach Island and Manalapan, it's a very small piece. We're not Miami. Miami is big and spread out, but Palm Beach specifically is very small,
I
which keeps the prices strong.
I kind of wonder about the social aspect. Last time I was down there was President Trump, so it was just like the Breakers and the Bath Tennis Club. But
yes,
now that all of my friends from the Upper East Side have moved down, like Bill Bouquet is open up down there,
yes.
La Lulu is open up down there. So you've got all these sort of Manhattan social staples that have moved to Palm Beach. What else do you see down there?
I mean, Palm Beach is really happening. I mean, all the New York City stuff, all of the, exercise classes, Sweet Green, like downtown West Palm is kind of what Tribeca was 10 years ago. You know what I mean? So it's very similar. And I think we're seeing Hotel Venetas, they're opening up. So they're the same owners of Hotel du Cap. We're seeing a lot of fun restaurants, and it's a scene. It's a scene, and it's a lot of fun. It's no longer your retirement place, I'll tell you that.
Well, Matt brought up the president. I went down there one weekend and with him, part of the press pool. And I will say, Palm Beach residents definitely get annoyed by the road closures that happen with President Trump. But it does feel like at the same time, he's almost like the hometown hero. Mm-hmm. Do you find Palm Beach to be Republican, or is it a bipartisan city? Is it this place that only the GOP
Are there any Democrats?
Are there any?
Question.
I mean, here's what I think. I think that because there's such a New York City connection to Palm Beach specifically, it is mixed. I wouldn't say that it's exclusively red, because there's a lot of New Yorkers, and New York is mixed, right? So there's blue and there's red. However, President Trump is most certainly, I would say, like an influencer. He's probably the biggest influencer. And there are a lot of people that want to be close to him, whether it's personal family friends, whether it's people that admire him politically. Before the election, we saw sort of a Trump bump in the estate section, which is that area surrounding Mar-a-Lago. Before the election, there was probably 6 properties that had sat on the market for 6 months or more. Right after the election, all 6 of them went within a short period of time. We were involved in all of them, I think.
Proximity to power, meaning
proximity to power. So, I mean, we base our, you have to look at facts, and what actually happened is he did create kind of a boom, and that's trickled in even past the election. And now we're sitting here in August, and there's definitely, it probably leans red, but there is blue.
Good to know.
Yeah.
Margit Brandt, thank you so much for sharing some of that insight with us this morning. Margit Brandt of Premier Estate Properties. Let's get you an update on stories elsewhere we're watching this morning. Here's your Bloomberg Brief with Lizzie Burden.
Hey, Annmarie. Federal Reserve Governor Christopher Waller expects the central bank to cut rates by a quarter point at its meeting next month. Waller said that with underlying inflation close to 2%, market-based measures of longer-term inflation expectations firmly anchored, and the chances of an undesirable weakening the labour market, he anticipates additional cuts over the next 3 to 6 months. And elsewhere, Nike is planning another round of layoffs as part of its efforts to get back to growth. According to an internal memo seen by Bloomberg, Nike said, quote, "The moves we're making are about setting ourselves up to win and create the next great chapter for Nike. The cuts will impact less than 1% of Nike's corporate staff." And finally, former MLB All-Star Mark Teixeira is running for the US Congress. The 3-time All-Star who won the 2009 World Series with the New York Yankees announced that he's going to seek the Republican nomination in Texas's 21st congressional district. The 45-year-old is aiming to succeed Representative Chip Roy, who's running for Texas Attorney General. And that's Bloomberg Brief. Annmarie.
What do you think of that, Matt? Baseball player.
Wait, is Texas Attorney General, is that Ken Paxton?
Paxton, yeah.
So he did mortgage fraud too? Is that the allegation?
The reports are that he has 3 homes listed as his primary residence, and he's also renting some out that are not supposed to be rented. But I'm asking you about the baseball player that might go to Washington.
I have tried and tried to care about baseball. From years of watching Tom Keene, I've been motivated to go and watch the Yankees, the dreaded New York Yankees, to go even to Citi Field and watch the Mets, but it's just way too boring.
Dreaded New York Yankees, that's where we cut it off. Up next in the program, the AI boom.
The godfather of AI, Jensen and NVIDIA, continue to dominate, and I think this is just a further validation tech stocks go higher. The boom's just starting. This just shows the next stage of adoption is actually just starting.
Gene Munster of Deepwater Asset Management joins us next. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. I'm Annmarie Hordern alongside Matt Miller. We are counting you down to the all-important 8:30 data print of PCE, then 10 o'clock in Washington, D.C., potentially some fireworks when it comes to what is going on with Governor Lisa Cook. Will she get this injunction to be able to sit on the Fed board, continue to do her job, and maybe even vote for an interest rate cut in September? Futures this morning are softer. We're on the red, down 0.3% on S&P 500 futures. But of course, we hit a fresh all-time high yesterday. Under surveillance this morning, the AI boom.
The godfather of AI, Jensen NVIDIA, continue to dominate. And I think this is just a further validation tech stocks go higher. The boom's just starting. I mean, if you look at these numbers, especially when you factor in what China is going to be, I mean, Jensen talked about 50 billion, 50% type growth number. This just shows the next stage of adoption is actually just starting.
Here's the latest. The Nasdaq sitting just below all-time highs, propelled by Wall Street's big bets on AI, despite lackluster results from NVIDIA. Gene Munster, managing partner at Deepwater Asset Management, is pushing past sell-side noise, writing, "The bottom line is we're still early in the AI build-out, and growth next year will be higher than most expect." Gene joins us now for more. So, Gene, you're pretty comfortable, it sounds like, with what's going on in NVIDIA's growth, even though it is slower than what we've seen in the past. Are you concerned, though, about where policy is going in regarding NVIDIA's access to China?
The simple answer is not concerned about policy. I think that that's going to kind of right itself in the next few weeks. Within their January quarter, they're going to see a big return in their China business that's, of course, not factored into the street estimates. My concern around China is more structural long-term, is that the Wall Street Journal this morning is reporting that Alibaba now is coming out with a new inference chip. Of course, we've heard Chinese leadership cautioning not to buy some of the H20s after what have been perceived as some insulting comments from the White House in terms of the types and the caliber of chips that they're being allowed to buy. All this in the background of what is clearly the most important topic for nations is where their position is within AI. And so when I think about the China opportunity, I believe that it's a huge opportunity for NVIDIA over the next year, 2 years. But I think that it's going to be increasingly competitive with the likes of Huawei, with the likes of Alibaba. Interestingly, that new Alibaba chip is reportedly able to work with a CUDA, which is the essentially the operating system around NVIDIA's chips. That's kind of part of the fabric that holds that very intense tech economy together for NVIDIA. And so the simple answer is this, is that it's going to get a lot better for NVIDIA related to China. I think if you take the perspective of 5 years from now, China doesn't want to be held accountable to owning U.S. chips, and Chinese leadership is making big investments. So it's going to get more competitive there longer term. Doesn't change how I feel about the AI trade. If anything, it actually makes me more confident about it. But I think that's the kind of the scope and the trajectory around China.
When it comes to China and U.S. policy, the CFO had this to say regarding that 15% that the U.S. government says that NVIDIA has to give back to the government for the export license. "I don't have to do this 15% until I see something that is a true regulatory document." So is it your understanding that basically the H20s can go to China right now and NVIDIA doesn't have to legally give the U.S. government the 15% the president said he had a handshake deal on?
It's my understanding that the licenses actually haven't been issued. Jensen made a comment about the timing of when those licenses are going to be issued. I think that separately, they still don't have clarity from the White House around the 15%. Why that matters for NVIDIA investors is it's still unclear about how that they're going to account for that 15% revenue share, and separately how they're going to think about potential price increases to offset that. And so that piece, as you are appropriately pointing out, kind of an important vector. And I think when you kind of put this whole mix together, I just want to take a step forward into what is going on with NVIDIA here. The stock is trading off after a very favorable quarter and what, in my estimation, was a better than expected guide. And I think part of that is related to some of the uncertainties that you talked about, timing of these licenses, timing of the revenue share. There's another piece that kind of vectors into this. which is NVIDIA's businesses, because China is getting a little bit smaller, is increasingly dominated by several companies. The top 2 account for just under 40% of revenue. I estimate the top 6 are 60%. And so there's this China and customer concentration that is a derivative of the China conversation. And so it gets quite complicated. And I just take the approach, at Deepwater, we take the approach of what's actually happening, what's the bigger picture, what's going on. And ultimately, we still think we are very early, second inning in AI. 3 months ago, I had said we're in the 3rd inning. And so I think we're actually earlier than what, as this is progressing. So really important to understand what's going on with these licenses and how the U.S. government, but ultimately the bigger picture is what's happening with AI demand over the long haul.
Well, and what's happening with return on investment here, Gene? Because we're looking at trillions of dollars spent to build up this infrastructure. You are one of the most famous tech analysts out there, and you've been through it all, right? You were there for the dot-com bubble burst when everybody was spending way more than they needed to, laying fiber for the money that they made in the years following. Are we seeing something similar play out now?
I think the big difference, first of all, is this return on investment question is valid because just a massive amount that's being spent. The best example of this, of course, is what's happened with Meta's business, is that this is a business that was growing kind of in the mid-teens. They pushed more for better targeting with AI, and now you're having a business that's consistently growing in the basically 20% range, their advertising business. I mean, remarkable at scale how AI is impacting Meta. So from my perspective, is just that one piece alone, I think, is a good evidence. One is I think back about what happened 25 years ago. There was a piece that we knew that the internet was going to be something big. There's a lot of commonalities. I think that when it comes to what's going on with AI right now, I think that you do have examples of what's going on with Meta about real, tens of billions of dollars of incremental revenue because of this, which we didn't see back in .com. I do want to just add one connection point to what happened 25 years ago and where we're at today, too, is there's this kind of ongoing conversation about the bubble. Where are we at? Are we in a bubble? We're not in a bubble. Looking back 25 years ago. And ultimately, we're not in a bubble. We will get to a bubble. I think that the market still has a couple more years to run here, and it's going to be a big bursting of the bubble at that point.
Not in a bubble yet. Gene Munster, thanks so much for your time this morning. Gene Munster of Deepwater Asset Management. Coming up, another hour of Bloomberg Surveillance. Michael Purves of Tallbacken Capital Advisors. Dana Telsey of the Telsey Advisory Group. Ryan Wang of HSBC and Zachary Griffiths of CreditSights. Of course, also coming up in the next hour, we will get the all-important inflation gauge that the Fed watches, PCE, coming up at 8:30 Eastern. Keep it right here on Bloomberg Surveillance.
If you look at what's driving the market, and is it a very small group of companies? Absolutely. That's very concerning.
What we're seeing in the large cap space is, at least on a short-term basis, a lot of good news is priced in.
Everybody at this point is functioning under the fog of uncertainty.
Markets tend to dislike uncertainty in any form.
There is a sneaky Uber bull case out there lurking.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Very good morning to you from New York City for our audience worldwide. This is Bloomberg Surveillance alongside Matt Miller. I'm Annmarie Hordern. It feels like a very sleepy Friday. It's a Friday before Labor Day. But Matt, we have some pretty important data coming up today. 8:30, in just 30 minutes, we are going to get the core PCE, which of course, this is something the Fed is very focused on. But how focused are they going to be on this data point, given the fact that last night, once again, we heard from Governor Chris Waller, and he said you can basically look through any tariff impacts when it comes, Matt, to inflation.
Yeah, and I want to point out also that we did hit all-time highs on the S&P 500
I was going to get to
yesterday. We are looking at a real seasonality issue because September is historically the worst month for stocks out of all 12. And right now, valuations are starting to look stretched again, right? In terms of the S&P 500, PE is at 25. So that's very high considering the average is around 17.
Yeah, and basically everyone is still buying into this equity market because the Fed's going to cut rates.
Right. Well, exactly. You had Christopher Waller saying, 3% is near enough to 2 for him because he's back in team transitory. He literally said that.
With air quotes. I think it's important we have to say I'm back on team transitory with air quotes.
Right. Nonetheless, he used those words, which I find fascinating. Of course, a lot of economists will look through, as you mentioned, tariff caused inflation the same way they would look through maybe sales tax caused inflation. But sales tax doesn't go up 5, 6, 7x in one month.
Coming up in the program, Matt, another hour, Michael Purves of Tallbacken Capital Advisors as stocks pull back from the record highs we had yesterday. Wang of HSBC reacting to today's key inflation data, and Zachary Griffiths of CreditSights expecting a 50 basis point cut at the Fed's next meeting. We begin this hour with stocks pulling back ahead of key inflation data, as we've been talking about. That's coming out now in 30 minutes as the Fed also has a battle of independence, and that is ramping up 10 o'clock today. That'll be key. Michael Purves of Tallbacken Capital Advisors writing, the more Trump pushes the Fed away from independence, the greater the upside risk becomes to back-end yield. Michael joins us now. Michael, thank you so much for joining Matt and I this morning, especially ahead of the all-important PCE report. When it comes to this question of Fed independence, you think that there is a Fed-Trump put at this moment?
Well, I think the question people have to get into is if Trump really does, get his team in there and really sort of has a firm, leaves a firm imprint on monetary policy, which basically is going to come down to what I think you could describe as sort of unnaturally lower rates, right? At least given the context of historical Fed response functions, right? Then you have to really question, well, what's going to then happen, right? And I think what's you're going to start seeing is a more exaggerated sense of what we have been seeing this summer, which is, look, we have seen the September rate cut locked. It started getting locked after the bad jobs report. It got locked again after Jackson Hole last Friday. And yet the 10-year has only bid marginally, right? Typically, as you get into a new cutting cycle, all the rates travel lower, right? You saw that a year ago. You saw that back in the 2018 into 2019 cutting cycle. There where the 10-year yield went down is basically as much as the 2-year yield did, as the Fed did that pivot, right? So the Fed is pivoting to some degree here. But if you look at the 30-year yield, that's actually higher. Those yields are higher now than they were before the bad jobs number. If you look at the Fed's calculation of term premium, the ACM term premium, that has been persistently, stubbornly high.
But Michael, can I just jump in here?
Yeah.
Is it that high if you're that concerned with Fed independence? Is 4.9% in a 30-year really that high if people are really concerned about not having an independent central bank?
Well, no, exactly. I mean, I think that's the point here. I think the question is that if he is successful in getting Cook out of the Fed and he's successful at really putting in sort of an uber dovish Fed, I think that you have to again get to the next question: is what is he going to do with that? Because if take a theoretical scenario where we get 200 basis points of cuts in the next 6 months, right, on a Trump-defined Fed, right? What's going to happen to the 10 and 30-year? They're going to go higher. Inflation expectations in the long run are, in my view, going to go a lot higher. And I think there's broader questions about, term premium, and then you're layering on hot monetary policy on top of a tax bill that is fiscal stimulus, on top of relatively low unemployment, right? So that's a recipe for all sorts of reasons to be, expect higher term premium, higher back end yields. That we know Bassett doesn't
Michael,
want.
Can I ask why aren't any of the president's advisors telling him how this works? Surely Scott Bessent knows that when you attack Fed independence, the term premium is going to get higher. So the Fed can cut rates, but the 10-year is going to be higher. The 30-year is going to be higher in terms of yields. And the president wants rates down, at least in part, so that he can pay less on the outstanding debt. But he's going to end up paying more on the outstanding debt when he goes after doves like Lisa Cook.
Not to mention the fact that the stock market cares a lot more about the 10-year than it does about the 2-year. Real estate assets care a lot more about the 10 and 30-year than they do about the front end, right? All that, right? The economy cares more about the 10-year, right? So this is where I'm going with this whole, where I think the plan is. Bessent has been very clear early in his term that he wants, he's really trying to get the president focused on the back end. So, play this out, right? If rate cuts, particularly if they're quote unquote unnatural rate cuts, are not the answer to lower back end yields, then I think it's got to be, he's going to rebuild the plan may well be to rebuild the balance sheet, right? We've done that after the GFC. We've done that after COVID. We did it during World War II. Well, we didn't do exactly balance sheet build, but we did do a form of yield control during World War II, right? So there is precedent. And I don't know how else they're going to get 10-year yields lower if they get a very, very dovish group of individuals running the Fed in there, right?
What are you looking for on PCE today, Michael? Because, Waller seems to think 3 is 2. But it's 50% more, obviously. And inflation is headed in the wrong direction. So it seems to me odd that the Fed would cut, especially that they would cut 50 basis points as inflation turns around and goes higher.
Yeah, look. The news we got from the July, since the end of July, was that the NFP was, 35,000 a month. There was weak ISMs. There, a lot of subcomponents of the services ISMs were really particularly weak there, right? And so there was sort of a rationale for after the July data hit. To sort of think about a September cut. I actually think Powell would be inclined to do a cut regardless of whether Trump were president or not, just based on the data. Would he do? Would it be a very hawkish cut? Quite possibly.
Everyone is talking about this hawkish cut, Michael. So basically what you're saying is one and done.
Well, I'm saying one and a lot of conditionality. We don't know what the fall is going to be, but I think there's a really ugly scenario that could be unfolding where if these trends of, to Matt's question about the PCE, look, the boogeyman of the inflation is really not the tariff. It's just really about that super core print we got in July was not pretty, right? And that's something that has a little bit of inertia away from all this tariff news, and that could be really much more troubling. Everyone's been so focused on the tariff-related inflation, and I think there's a very understandable debate about how long that is and what it really means. But the services stuff is something that's been, sort of lurking in the background for some time, and particularly on Supercore. So if that comes in, if Supercore comes in this morning and in the next CPI as being sort of unfriendly, I think we're going to see a really, really interesting fall.
How difficult, though, is a hawkish cut for Powell to talk about in the press conference when this is what Waller had to say last night? As I stand here today, I anticipate additional cuts over the next 3 to 6 months, and the pace of rate cuts will be driven by the incoming data. He is squarely looking at the labor market.
Yeah, I think he's also squarely looking at a job interview too. But
he's running.
but look, I mean, he's look. I think the jobs data has definitely, based on the July numbers and the revisions, right, was clearly weaker. I think the question we have to also recognize is that there is a lot of volatility up and down in some of this data, right? And I think there's a lot of understandable questions about labor force contraction and all that kind of stuff, right? I mean, if the immigration policies are constricting labor slack, right? I mean, I think that is one of those pro-inflationary dynamics that we're going to, the Fed's going to have to contend with there. But look, I think there's a wide range of scenarios that can play out after the September meeting, which may cause Powell to really reverse and pivot again, right? Again, I'm putting political noise to the side here, right? But what if we get strong inflation, in September and October after that cut? And the jobs data is sort of okay. What is Powell then going to do, as we approach the meetings at the end of the year? Is he going to do no cuts? Is he going to even maybe signal a hike back to where he was? This job is hard without having the president of the United States, be pushing on you every day, right? So there's a lot of strange currents in the data, and I think Powell's just kind of reading them as they come, right? There, but I think he's going to have to navigate that. And Waller's thing aside, he's being pretty clear about his views there. But again, people were very clear a year ago that the economy was definitely going to weaken. They had to get in front of the neutral rate as fast as possible. They gave us 50 cuts last September. 50 basis points of cuts, and that marks the lows across the curve of interest rates over the last 12 months. So, it's a very, very resilient economy, but there's a lot of complexities in the inflation data and also now the employment data.
Michael, thanks so much for joining us this morning. Michael Purves of Tallbacken Capital. Let's get you an update on stories we're watching elsewhere this morning. Here's Lizzie Burden. Hey, Lizzie.
Hey, Annmarie. President Donald Trump has revoked former Vice President Kamala Harris's Secret Service protection. Vice presidents normally receive 6 months of protection after leaving office, but according to CNN, Harris's protection was extended for an additional year by President Biden. Trump's directive to cancel Harris's protection goes into effect on September 1st. Elsewhere, the TSA is taking a heel turn on some long-standing practices at airport security checkpoints. For the first time in almost 20 years, passengers no longer have to remove their shoes and run them through X-ray machines. Officials are also now signalling that they intend to ease the rule limiting containers of carry-on liquids to just over 3 ounces. And over to sports, the Phillies' Kyle Schwarber joined an exclusive club last night, becoming just the 21st player ever to hit 4 home runs in a single game as the Phillies took down the Atlanta Braves. As for the New York teams, the Mets fell to the Miami Marlins 7-4, and the Yankees won their 5th straight game, defeating the Chicago White Sox's 10-4. And that should be my brief, Annmarie.
Lizzie, thank you so much for ending on the Yankees. Matt is here laughing. I promise I didn't do that.
It's just so, God love Lizzie Burden, right? A Scottish lass giving us the baseball scores. You've lived in England. They don't know how baseball works.
No, they're more into cricket.
Yes, I love cricket also. But
you don't like baseball?
Well,
cricket's even longer than baseball.
Yeah, but cricket
That's a weird take,
it's more
Matt.
of a drinking game, right? And baseball is just dead boring.
Baseball is not boring when you're rooting for the right team, which is the New York Yankees. Up next, the morning calls as Wall Street turns bearish on Marvel, plus Dana Telsey of Telsey Advisor Group as the de minimis exemption ends today. That's next. You're watching Bloomberg Surveillance.
The longer end, we've seen rates climb higher and higher and higher because there is this sense that whatever dovishness the Fed is going to undertake now, whether it's just the people on the FOMC becoming more concerned about the labor market or because the Fed is losing independence and is going to become more dovish, that we're going to have to pay for that sometime in the future with higher interest rates down the road. So that is where we call it zoo steepening because it's a bull market at the front and a bear market at the back.
Here's Brian Nick of NewEdge Wealth this morning. Actually, a viewer just wrote into me saying, you said it's a sleepy Friday for August, but don't jinx it. But that's what we do have this morning. Equities are pulling back just slightly, but we had a fresh all-time high yesterday on the S&P 500. And of course, markets are just over 10 minutes away from getting the important PCE inflation data. And then everyone else potentially can then go enjoy their long weekend. Time now for the morning calls. First up, Bank of America downgrading Marvel to neutral, seeing incrementally higher uncertainty. That stock is getting hit, down more than 14% this morning. Next up, Morgan Stanley raising its price target on Ulta Beauty to $600, seeing room for upside given the industry's minimal tariff risk. That is up more than 2.5%. And finally, JP Morgan raising its price target on Gap to $32, seeing a buying opportunity due to the post-earnings sell-off. And now we're going to stick with retail. Investors digesting a slew of earnings from the sector and their signals about the economy. Dana Telsey, the CEO of Telsey Advisory Group, saying the tariff impacts on EPS and margins are being managed and price increases have not been fully passed on to customers. The bulk are expected to be visible in the third and fourth quarter. And Dana joins us now. Good morning.
Good morning.
Very busy earnings season. When will we see the full impact of the tariffs?
I don't think you're going to see the full impact of tariffs until heading into the fourth quarter. And it's on a select group of merchandise. And frankly, when you think of the newness that's coming in, particularly on the apparel side, perhaps you'll see more of the price increases on the newer products, which you may not even know because they never were issued before. So that's some of the bulk of it. What we've seen as we've gone through earnings season is you haven't heard that it's been the full impact. And keep in mind, we've had a price tracker on 80 items since April. And what we've seen on iconic items, whether Levi's 501, Barbie dolls, we haven't seen big increases across the board. It's very selective with those price increases.
You know, the administration has long argued that this is just like a sales tax, and it's only just a one-time price hike. But the thing is, these tariffs trickle in over months and months and months, and the manufacturers try and hold back price increases when they can. So they take some into margins, they pass some to suppliers. I feel like we're going to see a step up of prices over time.
That's what's expected. The expectation is it will step up. And you're right, it's a third, a third, a third. A third look to diversify their sourcing. A third look to share the cost with manufacturers. And then a third of the headwind is passing the prices on to the consumer, which we not have fully seen yet.
What do you think about Jonathan Levin wrote a column for Bloomberg Opinion yesterday pointing out that we have higher PEs on some of these retailers than we do on NVIDIA. If you look at the forward PE for Costco, it's 52 times earnings, and NVIDIA is only 40. Why are investors willing to ascribe such a value to these retailers?
Frankly, for something like a Costco, you have annuity from continued membership. You don't have a lot of people not renewing their membership. The fact that you still have the opportunity to grow your unit base globally, that it captures such a wide customer. So I've got great value and prices. I've got a sticky customer base that's only growing, and I still have the ability to open more units. And don't forget Kirkland's. They've got private label that's of value that can expand to many more categories.
Fantastic products.
Yep.
I'm always impressed by Kirkland products.
Are you a big Costco shopper?
Yeah, love it.
Do you have a Costco membership?
Of course. I have the executive membership.
Wow, you're definitely a different person than I remember you a few years ago. So who's doing well in this environment? It's the Costcos, it's the Walmarts, because they're big and they're able to really mitigate these tariff concerns.
What about off-price? Look what you just saw at Burlington, a 5% same-store sales increase. Look at Ulta Beauty, very strong. That whole beauty category, there's newness in beauty and it's driving demand. What about the category of denim? And we've seen denim look at Levi's, they talked about denim. On the category side, I mean, Gap did well with denim, both at Old Navy and the Gap brand. And you're seeing in some of the intimates areas, the rebound of Victoria's Secret and the turnaround with the inflection point in intimates. Give consumers something that's new and different, they'll open their wallet.
But no denim intimates, I hope.
There's no denim intimates.
Oh my God. When it comes to, oh man, Matt.
TMI.
You've got to have good jeans, right?
This is the whole American Eagle debate. Is there, or do you see a push in retailers of trying to go to this cultural Americana?
You know what I think it is? The cultural, what's part of the conversation? So you look at the Cat's Eye group that basically has the Better Denim campaign for Gap. It's driving up tremendous number of views. You take a look what was just signed by Abercrombie, whether it is the NFL partnerships, whether it's the Dallas Cowboys. How do you remain relevant and expand your audience?
I saw that Brittany Mahomes is now going to be the face of Abercrombie. Travis Kelce, and I think this came out in the day they announced their engagement, is doing
American Eagle.
A partnership with American Eagle. You do have to have a celebrity endorsement tied to your brand?
It's working. I mean, you look at Beyonce and Levi's. And the effectiveness of being able to capture the number of their audience and their clubs, you're part of their club now.
By the way, I was shocked the other day when I looked at a TJ Maxx stock chart over 5 years. They've absolutely crushed it. Mm-hmm. And I'm guessing that like a Burlington and a Ross Stores and these discounters are all doing very well. What do you like the best? Like if you could own a couple of retailers, only a couple of retailers, which would they be?
So when you think of best in class in my world, you talked about Costco. Look at TJX. They are best in class. They have category strength. It's very impressive what they've done. You take a look, frankly, what Ulta Beauty is doing in the Beauty Unleashed plan with the new CEO. Well, she's promoted CEO, but it's working, and they're capturing a wider customer base. It's compelling. You look at brand leaders, and brand leaders like a Tapestry, like a Ralph Lauren, a Levi's, they're effective because they capture the consumer. And you think about what can be enhanced. Take a look at Bath & Body Works, watching that very carefully for the speed at which they're transforming their business model.
Why Bath & Body Works? Is that just like soap bombs or?
It's soaps and sanitizers, but what about 40 million loyalty members? 40 million loyalty members who are going there on a regular basis, that matters. And today, capturing that customer is key.
Here's the key. To me, that sounds like the consumer has too much money.
Well,
not yet.
Well, it depends. Some people like, special bath bombs and things like that.
And also there's a trade down.
Here's the big question, though, in the luxury market, especially makeup. Do you think consumers will buy a $160 lipstick?
Very expensive, more expensive than the Hermes $80 lipstick or Chanel $50 lipstick. Yes, there will be people who buy it because it's the entryway to, instead of getting the $2,000 or $3,000 Neverfull bag, you're going to get a $160 lipstick and you'll get a case that says LV.
Wow. You really think that people are going to buy this?
You can't surpass what a brand can generate with a lifestyle offering.
And for Matt, if you don't know, this is Louis Vuitton. They're introducing a new lipstick, and it's $160.
I'm surprised you haven't bought that lipstick.
I'm a lip gloss girl.
Okay.
That's what it is. Dana Telsey,
thank you.
Thank you so much for joining us. Dana Telsey of Telsey Advisory Group. But it's a great point, Matt, when you talk about what's going on with the Walmarts, the Costcos, the TJX. They're still doing well. And a lot of that has to be from the upper level income bracket, almost trading down or being willing to go out there and want to find better price points.
Yeah, I mean, I look at the TJ Maxx total return, 167% over the past 5 years. So they really have rewarded investors that made that bet. I still think, like a Bath & Body Works, if you've got money left over after going to the grocery store, after paying your car payment, after forking over the cash you need to for your GLP-1s, to go to Bath & Body Works, you just have too much money.
Well, we'll see about that. I think a lot of teens like it, and you have daughters. So one day you might be that dad in the mall at Bath & Body Works. We're minutes away now from the all-important core PCE print. Ryan Wang of HSBC joins us to react. Keep it right here on Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. We are just 20 seconds away from the all-important PCE data. And going into that, markets are a little bit softer on S&P 500 futures, treading water into this all-important data. Fed Governor Chris Waller told us yesterday, look through any tariff impact on inflation. He's squarely focused on the labor market. And yesterday, S&P 500 hit an all-time high, fresh record high. For that data that's just crossed, let's get over to Mike McKee. Hey, Mike.
Good morning. Well, the data has not just crossed. It's coming over a little slowly this morning from the Bureau of Economic Analysis, but we're just getting this here. The personal income increased 0.4%. Personal consumption expenditures increased 0.5%, which are exactly what was expected. Now we've got the inflation numbers, and they are as expected. A 0.2 rise in the headline and a 0.3 rise in the core on a year-over-year basis. No change in the headline, 2.6%, and the PCE core index rounds to 2.9%. Now I got a note from Omar Sharif of Inflation Insights just before we got these numbers, and he said at 2.9%, which would be the highest since February, is still not necessarily a sign that inflation is picking up significantly. So we'll keep an eye on that. The other number we got was the advanced goods trade deficit comes in at 103.4, I think, here, and at 103.6. And basically, this is a significant widening because we were at 84.9% in June, 84.9 billion in June. So a 7.1% increase in imports and a 0.1% decrease in exports. So, Annmarie, it looks like maybe we went back to the pre-tariff effort to bring in a lot of goods in July before the president put the final tariffs on.
Certainly it does feel like that pull forward effect was happening when you look at some of these numbers. But when it comes to the PCE, Matt, no surprise here. All bang in line when it comes to the core PCE.
Yeah, all exactly in line. So it's all the more interesting that you see the 2-year yield. It had risen up before this number came out to 364.40, and now it's dropped down to 362.80. I feel like PCE, and Mike, correct me if I'm wrong, PCE is so much easier for economists to predict because you get the CPI and the PPI before that, so you know the inputs in your model can work out pretty seamlessly.
Yeah, a lot of this data comes in other releases, so economists are pretty much able to get it spot on. We don't know the income and spending levels necessarily, but in this case, everybody forecast right. One thing we can tell you is that most of the personal spending came in the autos category. Motor vehicles and parts were up by 34.9 billion. Financial services and insurance were also up. So at this point, it looks like these were some goods in cars, but for the most part, it looks like services, financial services, housing, food, healthcare, and other services. So the spending numbers we'll get at the in this report suggest maybe that people did cut back a little bit on spending on goods.
All right, Mike, thank you so much for that. Hopefully you could dig a little bit deeper into what's going into that PCE number. Now we're going to get a reaction from Ryan Wang, the U.S. economist at HSBC. So what do you make of this?
Yeah, well, as Michael said, the numbers are broadly in line with expectations. I still do think it's important that we're seeing that step up in the core PCE inflation rate up to 2.9%. The Fed has been projecting that it will reach at least a little bit above 3% at the end of this year. And that's very key. I mean, if we know that inflation is going to go up, and then we're hoping that inflation eventually begins to cool off after the full effect of tariffs comes through, it's still important to track these numbers every month.
How uncomfortable is it to actually see on your screen 2.9% for core PCE, yet at the same time pretty much knowing the Fed is going to cut interest rates next month?
Well, that's really the tricky part. I mean, inflation admittedly is much slower than it was just a few years ago. We're not getting those types of price increases. But at the end of the day, 3% is still not the Fed's 2% target. And this is why, although we do have some kind of consistency amongst the Fed policymakers, Fed Chair Jerome Powell saying that, yes, okay, tariffs are going to be a one-time effect, even if that one-time effect takes a year or multiple quarters to fully pass through. But still, we need to track the data. And I do think, if the Fed does cut rates by 25 basis points in September, it's still not going to necessarily mean a sequence of rate cuts. And that's largely because of these inflation numbers.
Chris Waller called underlying inflation close to 2%. I don't know if he's a statistician, but do you agree?
Well, I just think it's very tricky to get into this idea of just excluding the tariff effect and trying to look at inflation on that basis. So no. I mean, if we were talking about core inflation that was below 2.5%, okay, now we're talking about a range that's sort of within a few tenths. But when you see an inflation rate that's closer to 3%, and really it's the mix of inflation that's coming through, some of it has been, incremental increases in goods prices that are clearly related to tariffs, but some of it has been on the services side, and that's more structural. Of course, services inflation tends to run above goods inflation, and although we've seen some deceleration in rental inflation, the overall numbers are still adding up to what we see, 2.9.
By the way, we were talking about this with Dana Telsey just a moment ago. The administration has argued that these tariffs are just going to be a one-time price increase. But I keep wondering, because the tariff structure is so dragged out, doesn't that lead to incremental price increases over time?
Well, I think we're definitely going to see a mix. If you really talk to businesses, they're adopting different strategies. Some businesses pass the tariff straight through right away. But that wasn't the majority. The majority adopted other strategies, front loading of inventory, selling down the pre-tariff inventory, and some have passed along a portion of those price increases, but not all of it. So I do think we're going to see an extended period where some products are affected by tariffs. Now, is that going to be enough to push the overall inflation number, let's say, to 3.5%, to 4%? I don't necessarily think we're going to get that high. I think more likely we're going to see this kind of sticky inflation close to 3%. We're looking for actually core inflation to still be above 2.5% at the end of next year. And so, again, there's this idea of a one-time effect, but that doesn't mean that one time is a short phenomenon.
By the way, they also wanted to average 2%, right?
Yeah.
And considering how high we've been and even how high we are now, we need to go far below 2% and hold there for years, if not decades, to average 2%, wouldn't we?
Well, that's very interesting because the part that was somewhat under the radar at Chair Powell's latest comments at the Jackson Hole Symposium is actually that the Fed is backing away from that average inflation targeting idea.
But they won't say
Isn't
it.
that
They're not
convenient?
explicit about it. It feels like they're targeting a range, but they won't actually say they're targeting a range.
Well, I think this idea that, okay, you have a 2% target and we want to pay a lot of attention to that number, but still there's some allowance, of course, for data noise. I think that is there. But I think we're back in a situation where bygones are bygones. We're not really trying to undershoot after the elevated inflation a few years ago, but we still do want to get back to 2%.
Governor Waller yesterday basically said he's all in on 75 basis points, except his view could change depending on the employment report. This time next week, we'll be looking at that jobs report. What are you and the team expecting?
Yeah, so, we're looking for a number that's around 70,000, right? So that would be pretty close to the July outcome, but it would be a little bit higher than the 3-month average of 35,000, which has attracted a lot of attention. Of course, we remember last month those massive downward revisions to really the May and the June data, right? So the tricky thing here is that we know that a slowdown in net immigration has played a huge role in why these numbers are lower. We know it's a combination of lower labor supply and lower labor demand. Both are playing a role, but we're not really sure which is the bigger factor. I mean, you could explain this slowdown just from slower population growth. Slower population growth probably has taken at least a point off of growth in the past year, both from a job side and also from a GDP perspective.
Ryan, when you look at the curve, when you look at the 10-year holding at 420 and then hear so many important, intelligent people talk about the dangers of attacking Fed independence, how do you reconcile those two things?
Well, I do think clearly this is a story that has evolved even in the last few weeks and months, and it is something that is very likely contributing to the steepness of the yield curve, right? So on the one hand, it's the Fed that has not really acted at all up until this point. And on the other hand, it's these concerns incrementally about what Fed policy will look like, not just for the rest of this year, but into next year.
Ryan, thanks so much for spending your Friday morning with us.
Thanks
Ryan Wang of HSBC reacting to the latest PCE inflationary data. Zachary Griffiths, head of U.S. IG and macro strategy at CreditSights, also joins us now. Zachary, I want to get into your bold call for September. Before we get there, just a quick reaction on what we saw in front of the data.
Yeah, thanks, Annmarie. It looks like the data is in line with consensus expectations. I think the uptick to 2.9% on the core PCE deflator is a little concerning. It highlights the inflation side of the concern for the Fed's dual mandate. But for us right now, it's all about the labor market in terms of the next adjustment to the policy rate.
When you're seeing these kind of inflation numbers, do you still expect the Fed to cut 50 basis points?
That's our base case. I think we probably need a little bit of help from the non-farm payrolls data next week. I think anything sub 60 will keep that 3-month moving average below 50,000 jobs. And to us, when you think about the Fed's reaction function a year ago and what we're seeing in the data now, it would justify a 50 basis point rate cut. And when we listen to what Fed policymakers are saying now, they are trying to dismiss the inflation concerns to some extent over the next several months, ruling them as transitory. We're a little shocked they're using transitory again at all, but you're hearing it. And what we're hearing from these policymakers, we think sets up for a bigger move in the near term to cut off those risks that we unnecessarily weaken the labor market further.
By the way, in terms of the labor market, it's the supply side that I think is so interesting as we pursue mass deportations and stop any entry at the border. even legal immigration now becoming more difficult. Doesn't that lead to some kind of upward wage pressure?
Typically, you'd think so, Matt. And I think what we're seeing is labor demand fall alongside labor supply, which for now is keeping things in a little bit better balance, but is not necessarily indicative of a very strong economy. And when we talk to our analysts on the consumer side, they are saying that for a while now, the consumer has felt softer than some of this macro data would suggest. And so when we think about the balance of risks of these job gains falling so substantially, we do think it warrants an adjustment to the policy rate. And when we think about going, say, from 4.5% to 4%, I don't think that takes us to neutral. It certainly doesn't take us to accommodative territory. And so if I'm a Fed policymaker thinking about the balance of risk to where policy is today, I think they can take it to the downside, and the renewed focus on the labor market and what we're seeing in the data justify that kind of move.
What will the benefits be or drawbacks from the big, beautiful bill? Annmarie was just with the president at his cabinet meeting, and he was, touting the fact that people won't have to pay taxes on Social Security. People won't have to pay taxes on tips. And all I could think about was all that extra money they'll be able to spend in this economy. Isn't that going to be a tailwind?
I think that is a tailwind, Matt. And when you think about all of the cross currents we Fed policymakers, all sorts of policymakers have to deal with right now, it's difficult to come out on the other side with a clear direction. And I think that's a challenge. I do think that the passage of the One Big Beautiful Bill Act is certainly a tailwind, at least all else equal. And I think you're seeing that in market pricing. But in terms of underlying economic growth, the strength of the consumer, what we're seeing from the lower income, lower wealth cohorts, I think there are some challenges there that adjusting the policy rate will at least help at the margin. And I think that's really the focus now. And I think there's going to be more fundamental concerns on the economic growth side. And we see that bleeding into corporate credit as well.
2 quick points there, though. When I was with the president, he said he doesn't want to call it the One Big Beautiful Bill anymore, Matt, because it doesn't really socialize to the American people what it does in terms of what you're talking about, and no tax on tips, no tax on Social Security. But Zachary, can I push back for a second? Besides on the margins, the One Big Beautiful Bill just keeps current policy. No one's really getting a massive tax cut, are they?
No, and if you think about tariffs, they are a tax on the consumer to some extent. We could argue for hours who is paying the tariff. Is it the consumer? Is it the importers? Or are the exporters actually taking a share of it? I do think it's divided perhaps somewhat evenly between the three. And so if you think about those impacts on net, it probably nets out to a certain extent. And I think you make a great point on just extending what had been existing law and avoiding a tax hike in terms of allowing the 2017 Tax Cuts and Jobs Act cuts to kind of roll off. And so to think of it as a big incremental tailwind is probably not the right way, especially when you consider the policy coming out of Washington as a whole.
Hey, you're head of USIG and macro strategy, so we can talk to you about more than just the economy here, Zach. And I wonder about spreads being so tight. Since I'm an equities guy, right, I typically anchor the Bloomberg Open Interest show from 9 a.m. to 11 a.m.
My dad calls you a car guy, actually.
And I'm a car guy. But I can't get my head around why credit spreads are so tight here, considering the fact that we're seeing, for example, a big jump in bankruptcies, considering the fact that you have this worry about consumer softness, considering the fact that we're running up these massive debts, like leverage is out of control. So why are spreads so tight?
That's a great point, Matt. And I think we're a little surprised, to say the least, just how tight spreads have gotten and remain. And I think a point that you've been making throughout the show today is the technicals. There's a lot of cash in the system, and a lot of investors need to put that cash to work. And I think that's really been what's been driving spreads and asset prices across a broad swath of asset classes so far this year. We're a little shocked that with the amount of volatility we have in terms of policy setting, the way the Trump administration has gone about implementing some of its policies, and you think about Fed independence being called into question so directly. If you had lined up all of these factors for me coming into this year and where I think spreads would be, it'd be a lot wider. I don't think we'd have equities at all-time highs, and I certainly don't think the 10-year would be stuck at 420 to 425 with all of this coming out of Washington. So I think it all speaks to the strong technical in the market. It's impacting a variety of asset classes. And while we do expect that to shift over the next 12 months, for now, that seems to be in the driver's seat in terms of what's driving markets.
Zachary, thanks so much for your time this morning. Zachary Griffiths of CreditSights. He's calling for a bold call, Matt. Fed cuts 50 in September, but all of this really hinges on what happens next week.
Yeah, absolutely. I mean, the labor numbers are so important, and unlike today's PCE number, that really could go either way. It's not going to be bang in line, not quite as easy to figure out.
Yeah, definitely not. Let's get you an update on stories we're watching elsewhere this morning. Lizzie Burden is back with your brief. Hey, Lizzie.
Hey, Annmarie. Fed Governor Lisa Cook is heading to court this morning to try and keep her job. Cook says President Trump is using a phony pretext that doesn't amount to sufficient cause to fire her. Cook's lawyers suggested an unintentional clerical error may have been behind the mortgage dispute at the centre of the clash between her and the president. Elsewhere, European leaders have referred Iran to the UN to re-up sanctions against the country after Iran failed to comply with demands over international inspections of its nuclear program. Iran has threatened to leave the Nuclear Non-Proliferation Treaty if UN sanctions are resumed. And Jordan Hudson, the 24-year-old girlfriend of legendary NFL coach Bill Belichick, 49 years her senior, I might add, has filed a trademark application for the phrase gold digger with the stated intention of using it on jewelry and keychains. The application also had other Belichick-related trademarks, including Chapel Bill, the All Belichick Team, and the Belichick Way. Well, Annmarie, I'm not saying she's a gold digger. That'll be my brief.
Well, here's the thing with this entire story, Matt. And thank you, Lizzie. How do you want to copyright gold digger when it's just been used nonstop in music and in books?
Was there recently a song called Gold Digger?
Yes, with Jamie Foxx and Kanye West. But I do say this is capitalism. This is something people are, saying to her, this is what you are, and she's taking a moment, opportunistic, and saying, actually, I'm going to lean into it.
Hey, and we're in a very transactional moment right now, right? Considering this president, it doesn't, I think, surprise many people. I wonder if those two hang out in Palm Beach a lot.
Not sure about that, but we'll see whether or not she gets that trademark. All right, up next, setting you up for the day ahead. Plus, Tyler Kendall is back as the battle between President Trump and Fed Governor Lisa Cook heads to court. You're watching Bloomberg Surveillance.
The for-cause protection and the idea that this establishes a high standard before a president can consider removing a Fed official is central to our understanding of how central bank independence operates in the U.S. So there's a lot at stake in this litigation.
That was Krishna Guha of Evercore ISI. Markets this morning are just a little bit softer, those futures, after PCE came in bang in line. And yesterday, of course, the S&P 500 hitting an all-time high. We're under 40 minutes away from the cash open. Here is your trading diary for the week ahead. 10 a.m. Eastern today, we have Mitch, consumer sentiment, and Lisa Cook, as well as 10 a.m., heading to court for an emergency hearing in her legal battle with the president. Monday, U.S. markets are closed for Labor Day. Tuesday, ISM manufacturing. Wednesday, JOLTS data, plus the Fed's beige book. Thursday, another round of jobless claims. And of course, Friday, the all-important, the big one. We get the August payrolls report. Turning back, though, quickly to the legal fight between Trump and Governor Lisa Cook. Bloomberg's Tyler Kendall is outside the courthouse in Washington and joins us now. Tyler, what's the latest?
Yeah, hey, Annmarie. Well, I'm expecting it to get a lot busier where I am shortly, as this federal judge is expected to start looking into this case brought by Fed Governor Lisa Cook against President Trump over his attempts to oust her from the Federal Reserve. Now, the first matter at hand is that Cook has filed for what's known as a temporary restraining order, which would reinstate her while this works its way through the legal system. But I want to make an important distinction here, which is that a temporary restraining order is just that. It is temporary. And typically, they only last about 2 weeks. That would not cover us until the September FOMC meeting. With that said, a legal expert tells me that it's up to the judge's discretion and that they could actually extend this further. That doesn't necessarily mean that they're going to take into account that policymakers are meeting, but rather it is more likely that a judge extends a TRO until they are able to rule on what's known as a preliminary injunction. That is more long-lasting. That would reinstate Cook into her position until this is all done and dusted and the final court case over her firing is decided. Matt and Annmarie, I'm taking you through all of these steps basically just to say that we have a long road ahead of us, but today is an important first step.
Right. And while I don't think anyone doubts that she can get an injunction, and also it doesn't really matter if she votes September 17th because she leans dovish and would likely vote for a cut anyway. The important thing, I believe, Tyler, is if she's still there in February, right? Because the concern among people who value Fed independence is that the president is trying to take over the Board of Governors so that he can have a bigger influence on the regional presidents. And that all happens, those confirmations, in February.
Right, exactly. And actually, Matt, it happens once every 5 years, and it just so happens that it is happening this February. And if President Trump is successful in removing Lisa Cook, then he would get that majority. 4 out of 7 of the federal Board of Governors seats would be Trump appointees. Now, our reporting had indicated earlier this week, a person familiar saying that the White House's goal here wouldn't be to make the FOMC more dovish, but rather to provide more scrutiny on the vetting process of these regional bank presidents, which are not Senate confirmed. But of course, this raises questions about the pressure campaign and how potentially this reappointment tool could be used to pressure these officials when it does come to meeting time.
Tyler, thank you so much. Tyler Kendall, we'll be looking forward to Tyler's reporting throughout the day, especially at 10 o'clock. Matt, thank you so much for joining me. I knew it was a sleepy Friday when they said you two could do the show together.
When they allowed this to happen. No, it was a pleasure. And by the way, I will be on air at 10 o'clock when this comes out, and also when we get some more economic data.
Tuesday, John and Lisa will be with you. I'll actually be on assignment. Jay Pulowski of TPW, Matt Hornbach of Morgan Stanley, Julie Bale of Kanye Anderson.